This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Starting a new fresh week here on CNBC-TV18. You're with us here on Bazaar Morning Call. We're coming to you from the CNBC-TV18 Motilal Oswal studios. There is so much which has happened over the weekend, taking off, of course, from where we left off on Friday, and lots of cues lined up all of this week as well. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. Well, so much happened over the weekend, right? Of course, you had that India-Australia win yesterday. But apart from that, I think what's happening in Israel and the conflict with, Israel and Palestine is really... it's heartbreaking to see. It's one of the, I think, the biggest attack on human civilization, at least I have seen so far. The death toll as of now is over 1,000. And, your heart goes out to the victims, the families, people who've been separated from their loved ones. I understand that there is a lot of politics involved as well, but keeping the politics aside, nobody should be, witnessing or going through something as horrific as this. So, condolences to all the people who've lost their families, their loved ones. And of course, this is something that will have ramifications on global markets as well. But as of now, it's really, really heartbreaking to see.
Well, we're going to be talking about markets, spike in crude oil prices, trade relations as well. But for the good of humanity, we don't want to see anything like this happen, right? And de-escalation and just resolvement of this is
peace,
something,
right?
just peace, that's something that you're looking forward to. But during the course of the day, since, we'll be tracking business news, we'll obviously be looking at the markets. But, Sonia, on a brighter note, yesterday with regard to the sports action was quite encouraging. And on Friday, India went ahead and won the Asian Games as well, hockey.
Yes.
I mean, I'm an enthusiast, so there. So
total tally is 107.
More than 100 medals. So that's,
more than 100. So
that's very good. And last night, Sonia, Arsenal beat...
The Arsenal Man game. I was going to talk about that, but, somber things happening around. But, of course, that was a really good one.
After so long. Lovely.
All right, well, let's kick it off in terms of what people would like to know in terms of how things are set up this morning, right? And we have to start with, of course, not what happened on Friday in the US, but start with what happened over the weekend and absolutely tragic developments in the Middle East once again. I mean, more than anything else, it kind of underlines how fragile that region is, right? I mean, West Asia, Middle East, and the attack, one of the largest by Hamas on Israel, the retaliation, and of course, I mean, the rising death toll. The only hope is that, like the previous extreme periods, we've had one in 2021, one in 2014, one back in, between 2000 and 2005. This one is limited. So that'll be the big one that we'll hope out for. But, these events, of course, have sent a big risk jolt, right? Risk-off jolt, rather, to the markets. So when you look at the S&P 500 futures, the last I checked, they were down about 0.75%. Oil prices rose 4%. They almost hit the 5% level. With oil, of course, the big risk here is disruption to supplies, which, of course, as of now has not materialized. But markets, of course, would price some of this risk in. So prices have went up. Now, the bigger concern is that this kind of spirals out of control in terms of, a proxy war, right? Iran getting involved. There's a Wall Street Journal article this morning which talks about how, the go-ahead for the attack was given by senior leadership in Iran. But that's, of course, that story from the Wall Street Journal. But that's the big risk, that this kind of escalates out of control. Market reaction, I already mentioned what the U.S. sort of indices and oil prices are doing. But the Israeli benchmark index fell 6.5% over the weekend. So that's a big one. Let's rewind the clock back to what happened on Friday. I mean, had this not happened, you would have kind of come out with more confused kind of signals. And I'll tell you why. This, of course, is now risk-off. But you had the U.S. jobs data, which kind of completely smashed expectations as against the poll of 170-odd jobs to be added. The headline number went up 336,000. That's the most since January that we've had. Details like the unemployment rate, average hourly earnings, all of those were kind of mixed, in line, softish. But it's kind of hard to get anyone to focus on the details because the headline number is such a big one, right? Such a big, outlandish kind of beat. Now, the reason I said you perhaps would be a little confused if the events over the weekend had not happened and we were just kind of taking the handoff from Friday markets went up. The S&P 500 was up about 1.25%, almost 1.25%. So we saw what is a bullish outside day. Technically, it's a very strong indicator that maybe, the index, which has seen this pattern, will see continued gains at least for a few more sessions. The Nasdaq ended up about 1.6%, which was even stronger. The dollar index saw a bearish outside day. That's below 106.32. We left off at about 106.12 or so. Now, that signals that the dollar perhaps should be sharply lower in the coming days. Now, of course, events over the weekend and what has transpired will change some of this, but that was the handoff from Wall Street. Yields, they went up. I mean, Treasury yields, it's not as if yields also sold off. They went up 7 basis points to about 4.79. The high was 4.88, the middle of last week. So we're just about 10 basis points away from the highs. But, I mean, equities and other stuff actually did quite okay. Now, coming and tying all of this back to the market here, this is the rally from Wednesday's low for both the Nifty and the Bank Nifty. 300 points on the Nifty, and which is about, what, a little over 1.5%. And the Bank Nifty, which went up 500 points, that's just around 1.1% or so. So the rally on the Nifty has been stronger as compared to the Nifty Bank. This is from the lows on Wednesday, beg your pardon. For the Nifty, the next logical resistance is the 20-day moving average, which comes in at 19,787, which is, some distance away, but that's the 20-day moving average. That's the big one. On the downside, the attempt should be to close above the 40-day exponential moving average, which the market was able to take out with Friday's rally. That stands at 19,610. And then the low, of course, will come in, which is 19,333. Big 300-point gap between, that 40-day exponential and the low that we saw last week. Now, on the Bank Nifty, the resistance comes in at 44,717, which is the 40-day exponential. And then you get to the 44,983 level, which is the 20-day moving average. As I said, the Bank Nifty recovery has been a little weaker. Support for the Bank Nifty comes in at 43,857, which is the low that we saw last week. But also, it exactly coincides from, if you draw a trend line, from the lows of June. It's a slightly upward sloping trend line, and that meets the Nifty at about 43,857. The GIFT Nifty should come up on your screen. It's indicating a 40-odd point lower start. Not just because of what has happened over the weekend, but even, had that not happened and we were just picking up from Friday, U.S. markets were up, but yields were up once again, right? So it was a confusing kind of handoff, and that's the reason why I would say hold off, especially now that what's happened in the Middle East has happened. And I think we will be dealing with the implications of that over the next many hours and next couple of days as well, unless, of course, things diffuse pretty quickly. So, watch what the price wants to do, watch what the market wants to do. A couple of 100 points is what the market has done. But in the larger scheme of things, it's better to get clarity and then take positions one way or the other. The implied open, about 40 points lower. Sonia.
Absolutely. My point is that despite everything that has happened, right, the Dow futures are down about 200 odd points. Oil prices are higher by about 4%. Yeah. Yes, there could be a sell-off across the globe, but give and take everything, the GIFT Nifty is suggesting less than a 50-point cut. So this is definitely a buy on dips market. Yes, agreed that things could escalate over the next many days, but it would be prudent for you as a trader or an investor to look to buy every dip, because this market has been very strong up until now. So that could be the base case where buying every dip could be a prudent strategy. I'll tell you why. The Nifty has been very resilient amidst all the weak global cues. It closed above that 19,650 mark on Friday. The reason why you can perhaps choose to buy the dip is because FI selling has also reduced substantially in the last many days. There was barely selling of about 90 odd crores on Friday. And if you map the last 4 or 5 days, right, there was selling to the tune of 2,000, 3,000 crores in the preceding days. And just look at that, it's reduced substantially. So I think you should look for opportunities to perhaps get into the market if it falls further, because of a couple of more reasons. Q2 earnings also begin this week, and you have all the IT companies reporting their numbers. The big narrative is that the commentary perhaps from the IT companies could improve in this quarter. And if you factor that into the stocks, a lot of these stocks have seen a recovery as well. So we kickstart with TCS on Wednesday, then you have Infosys and HCL Tech on Friday. If there is a slight hint of a recovery in demand from managements, which is what the street is expecting, then that could be another positive trigger that we're looking at. So that's the big question. Is the worst of demand deterioration behind us? Could be. And what's the outlook for tech companies in FY25? The other positive that I'm looking at is a lot of business updates from corporates in our own, universe, which are very positive. So look at Titan. Revenue growth of 20% is what they've spoken about. TCS, of course, will be considering a buyback as well. So that's another thing to look forward to. Prestige Estates reported almost a 70% growth year on year in its total sales. So, the base case is that, yes, there is global chaos, but our own markets have been so strong that perhaps they could decouple from what we've seen. So maybe you should look for buying opportunities, at least in that, in good quality stocks.
Yeah, that's provided the de-escalation takes place out there. You don't want any kind of, further bad news coming in from there. So market participants will be looking at de-escalation of what's going on in Israel, and for the good of everyone as well, we're hoping for that. The global cues, well, they could be preventing the Nifty from moving to around the 20 DMA. After the last couple of sessions, well, it appeared that the 20 DMA was well and truly on, but it seems now it could be pausing a little bit, going by the economic data we're getting from the United States, as well as the conflict that we're seeing in Israel. For me, the biggest component is the Nifty Bank, which hasn't been performing. Even the last week, you'll see the Nifty ended mildly in the green. But the Nifty Bank was down close to around 0.5%. So that's been underperforming. That needs to perform to get the Nifty towards, closer to around that 20 DMA and then around the 20,000 odd mark. So that's going to be the key contributor. If today, in fact, you believe that there is going to be some money that's going to be moving to the Nifty Bank, that's going to lead the recovery. And besides the Nifty, we talk a lot about the Nifty, but the broader markets, there's a lot of stocks that are still doing very, very well. So be stock specific, look to buy good stocks if you're looking at buying from the broader markets. And even on Friday, you had an outperformance out there. We've been talking about, the FIs being net short and not being such a bad thing. Just take a look at what's taken place in the last few days. The short positioning has come down. Even on Friday, you saw some covering of short positions. And from, the middle of last week, when you had the net short positions of FIs go to around 92,000 short contracts, we have seen close to 8,000 contracts getting closed out. And that's why now the net short positioning has come down to around 84,000 contracts. Just a few sessions ago, we went all the way down to 19,330. And in that span, you've seen these 88,000 contracts getting closed out, and the Nifty bouncing close to 320 points odd. So having shorts in the system, in fact, it's proved to be a good thing. Nifty support levels, what are we looking at? Well, the first support comes in at around 19,500. I'll give you reasons for that. 19,600 put saw a fair bit of action. The premium at the start of the trade was close to around 100 points. The other factor is 19,500 put has the highest open interest. So that's why 19,500, if you have that appetite to go ahead and buy the dip, 19,500 becomes the first support level. The next support level is last week's low, which is around 19,333. The resistance level will be the 20 DMA, around 19,800 odd. So if you have the appetite, you should be looking at buying this dip. And you'll not want a 30, 40 point downtick. You'll want to buy a little bit deeper, maybe a 70, 80 point downtick, closer to around that 19,500 odd mark, and hope that the Nifty rebounds from there on.
Okay, lots to talk about and lots to digest actually with what's happening across the globe. Pretty gruesome images as well. We'll try and get you more details on all that's happening. But in the meantime, we have a market to trade. So let's get with it very quickly. On the equities front, first up, Chetan Seth of Nomura says the main focus will likely be more on the geopolitical events in West Asia. In particular, whether the conflict broadens out regionally and is long-lasting. In the Asian equity space, assuming oil prices surge in the days ahead, some major ASEAN net oil importers like India and the Philippines may underperform. That said, assuming this does not turn into a wider and prolonged conflict, they think it might ultimately be a buying opportunity for Indian stocks given the strong structural outlook.
All right, we have another opinion. This is coming in from Mahesh Nandurkar of Jefferies, who says that FY24 is headed towards a $35 billion plus equity supply, which is the highest ever, even without much funds raised by banks. The data for 9-month calendar 2023 has seen over 100 promoter or PE exits in deals worth $19 billion. 74% of these exits are PEs, large investors, and Adani sell-downs, which is healthy. The PE plus promoter holding in India is large, and in buoyant markets, such source of supply can't be ruled out. So unless FPI flows improve, they expect equity supply capping the near-term market upside.
Let's also tell you what's happening in the money markets and get you some views on the rupee. B. Prasanna of ICICI Bank says the dollar strength is ebbing a bit despite strong headline jobs data. Pressure on emerging market currencies continued due to rising US yields, but moderated owing to central bank intervention. Rupee remained in a tight range supported by RBI intervention. Hawkish MPC policy and pause in dollar rally should give a near-term relief to the rupee, while events in West Asia may emerge as a risk factor through a spike in oil prices. He expects the rupee to trade between 82.80 to 83.50 this week.
On bonds, B. Prasanna of ICICI Bank says global yields are consolidating at recent highs amidst strong payroll and economic data. Domestic yields inched sharply higher as MPC delivered hawkish pause with optionality of using open market operation sales, OMO sales, to manage liquidity, which spooked sentiment. With crude prices also posing a risk due to geopolitical developments, he expects the 10-year benchmark here to trade between 7.3 to 7.4%.
Well, a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. But let's run you through the list for the time being. We're looking at Reliance Industries, TCS, Titan, MCX, Prestige Estates, Solar Industries, JOCL Corp, and ONGC. All of them will be reacting to positive news flow, while on the flip side, Bank of Baroda and Biocon, that will be reacting to negative news flow over the weekend.
Okay, well, let's get some perspective. Ed Yardini at Yardini Research is now joining us. Ed, good to have you with us here. Good morning. What should we start with? Let's just start with what's happened over the weekend. I mean, it's not new, but the scale of it, of course, is very large. It's a very old conflict. How would you read this, and what are the implications for markets according to you? Ed, I think you'll have to unmute yourself, Ed.
So you're right. Sorry about that. Can you hear me now?
Yes, please, go ahead.
Yeah, I apologize for that. Clearly this is a horrible situation, and the human toll is awful. In terms of the financial markets, I think in the past we've seen a knee-jerk reaction where the stock market's down and oil prices are up, and we're already seeing that in the futures markets. I think that much will clearly depend on how long this lasts. This one could last a while. It really depends on the extent to which the Israelis go into Gaza and try to root out Hamas. I mean, that could take a long, long time, and it could become a very protracted and a much bigger war if the Hezbollah up in the north starts launching rockets, and then of course Iran and Israel could wind up getting into the fray of this whole thing. So I would not get, I think we have to wait a little bit. I don't think that the geopolitical consequences of all this are easy to predict. This one may be different than some of the short-term problems we've had in the Middle East. So caution is probably the correct way to approach it.
Caution is the correct way to approach it. Got that. Ed, hi, good morning, and thanks for joining in. Of course, it is a horrific situation that is playing out before our eyes. So keeping the human emotions aside, if you just go by history, right, in hindsight, for an investor sitting in India, global or geopolitical issues have always been the best buying opportunity, just because of how far out we are in terms geographically.
Yeah.
Do you think this time could be different, or should one use this as a buying opportunity in a market like India?
Well, India is a significant importer of oil, so much will depend on the price of oil. But as we've seen just recently, before this conflict started, the price of oil went up and then it came right back down. The demand is very sensitive to the price. And so we have seen that once you get up to $90, $95 a barrel, you do get demand destruction, which brings the price back down. So the risk is that this will become a much wider conflict, and that Iran's production will be impaired dramatically. But on the other hand, the Saudis would probably start to pump some more. So I think that the markets right now, the reaction isn't as bad as one would think. The stock market futures for the S&P 500, or the Dow, I should say, down about 200, which is certainly not much of a reaction. The oil price can be very volatile, and I also don't think that's going to stay up. But I think for India, this too shall pass, as this has in the past. And I think the fact that India is remotely related to any of this, other than through the price of oil, makes India a candidate for some area of stability on a global basis.
Hi, Ed. Good morning. The last time we spoke, you were telling us about maybe it could be wise for the Fed to pause in the near term, going by, what we're seeing in terms of economic data as well. What did you make of the jobs report? First look at it, it looked red hot, but then you looked at the wage number and you said, hey, it's not that hot, and that's, I think, what the market grabbed onto out there. How do you expect the Fed to move from here on?
Well, I think the Fed has to recognize that the economy, while the economy has still been very resilient, they don't want to push this thing too far. I mean, if wage inflation is coming down, and if we get a decent CPI, I think the expectations is 0.3%. Could be lower if the rent inflation finally comes down. I think inflation is coming down without a recession, if that's the case. And I don't think the Fed wants to should push this thing too far. The other thing to recognize that the Fed needs to recognize is that this incredible increase in the bond yield is already a form of tightening. The bond market's doing a lot of the work for the Fed from here on. I mean, let's face it, 10-year bond yields close to 5% is really quite a disaster for commercial real estate. So we've had this rolling recession that's now rolling through commercial real estate, and I don't think the Fed really needs to do any more.
So before we let you go, Ed, you're saying that it's better to be a bit cautious now, even for a market like India. But given that this too shall pass, one should be looking at some interesting buying opportunities here. Is that the right way to look at it?
I think that is the right way to look at it. Here in the U.S., I think that, once we get some idea in the next few days of the extent to which this is going to remain relatively contained, I think the good news is that we're entering our third quarter earnings season. The good news, obviously, for the financial markets, not geopolitical, but the earnings outlook is pretty bright. I think we're going to have better than expected earnings for the third quarter, and that may very well allow the market to maybe hold its 200-day moving average here for the S&P 500, and then set us up for a year-end rally if things don't totally blow up on a geopolitical basis.
Okay. Just one quick last word, Ed.
Sure.
So yields went up 7 basis points on Friday. The S&P ended, the Nasdaq actually ended about 1.5% higher as well.
Right.
So how do you square that, both those things?
Well, I've been thinking about that quite a bit, and we're going to do more work on it. But I think a lot of these big cap Nasdaq companies are less exposed to interest rates than one would think. I mean, everybody knows that growth stocks are supposed to go down when interest rates go up. But what if those growth stocks don't have much debt compared to other stocks? And I think that's part of the story here, is people are recognizing that the mega cap 8, for example, just don't have that much debt and aren't that exposed to higher interest rates.
Okay. All right. Well, that's possible. Absolutely. Thanks very much, Ed. Good speaking with you as always here on CNBC-TV18. Appreciate you joining in with all of that perspective. We'll take a very quick commercial break here. We'll be back. Our list of top 10 stocks to watch for the day with our research team coming up next.
Welcome back. Our research team is standing by with a list of top 10 stocks for the day, and there are plenty to talk about. First up, Reliance Industries is in focus. Mangalam is here to give you the latest on that. Mangalam, good morning.
Good morning. So Reliance has another fund infusion coming in for their retail vertical. So we have ADIA, which will invest about $500 million of 4,967 crores for about 0.6% stake in the company. And this values the company at around $100 billion, in line with what the recent investments have been. But remember, ADIA had earlier invested in the company in 2020 at a valuation of 4.285 lakh crores or $50 billion. So this is an additional investment. So their overall stake will be 1.77 odd percent. Remember, last month itself, KKR's follow-on investment also increased the stake to around 1.4%. In just the last couple of months, we've seen fund infusion coming in Reliance Retail at $100 billion from QIA, which is Qatar Investments, KKR, and now Abu Dhabi Investment Authority.
All right, Mangalam, thanks a lot for that. And belated happy birthday, Mangalam. Hope you had a good day yesterday. And wish you well, brother. Always. We look forward to better times during the course of the day as you treat us. But
thank you so much.
That last part was most important, right?
No, good wish. Good wishes above everything, Mangalam. So wish you well and hope you had a good day.
Thank
Let's
you.
move on to the next stock. We have Rima, who's joining in to tell us about TCS. They announced that buyback, which the street seemed to be sniffing towards the end of Friday's trading session. Rima, tell us more.
Hi, thanks so much for that. So on Wednesday, that's 11th of October, TCS will consider a buyback along with their Q2 numbers. So the announcement will only be known post-market hours, closer to 5:30. This would be TCS's fifth buyback. The estimates are that it will be close to about an 18 to 20,000 kind of a buyback, similar to what they did last year. Last year's buyback was announced in January and it took place in the month of March and April. That was also an 18,000 crore buyback, which the company had done. JP Morgan estimates the buyback size would be 18,000. IFL Special Situations Team estimates the buyback size could be 18 to 20,000 at a price of 4,300 to 4,500 rupees per share. And some of the previous buyback rates will also come up for you on your screen. Morgan Stanley says that this buyback was anticipated by the street for the last 2 quarters, and according to them, it's unlikely to be very, very supportive. It is supportive, but not materially supportive for the stock price. Back to you.
All right, Rima, thanks very much for that. It's a big one. It's been done before, coming up again, the buyback from TCS. Well, Titan is the next one in focus. The pre-quarterly updates looking strong on the jewelry side. Back to Mangalam. Mangalam, morning.
Good morning. So looking strong, in fact, 2 reasons why it looks better than, what the numbers would just say. One, it's a 22% base that the company had in the last year. And at the same time, there was the Adhik Maas in the second quarter. So a lot of people on the street were expecting a subdued quarter. But despite that, the company has reported an overall revenue growth of 20%. Jewelry business has grown about 19%. And in that, the domestic jewelry business itself has grown 20%. Apart from that, Carrot Lane, which is likely to be their main growth driver after them having increased stake in the company, has also continued its growth path. Around 45% growth is what that has reported too. The company said the growth has been led by both double-digit growth in buyers and ticket sizes. Studded activations have done well for them. Premium diamond has also done well for them. So to that extent, margins will be extremely important to watch out for. One would be tempted to compare that to 32% growth that Kalyan has reported. But on a 3-year CAGR basis, the numbers are pretty comparable. Titan has done around 20.5% versus Kalyan at 22%. And remember, in the last 1 year, Kalyan Jewellers has seen a stock price rise of 154%, whereas Titan has seen a rise of just about 18%. So I see mild green on that one because the street will now await margin details on this.
All right, thanks a lot for that. And in the past 6 months, in fact, Titan has had a very strong run. I mean, 6 months ago, the stock was at 2,500 and now Titan is at 3,300 plus. So let's see. Of course, green on that one expected today. But Bank of Baroda is the other stock we're looking at. Abhishek is here to give us the fine print. Abhishek, how did it look?
Well, Sonia, the domestic business momentum on a sequential basis, that looked to be on the weaker side for Bank of Baroda. Even the domestic CASA ratio is below the 40% level for the first time in last 12 quarters. So the net interest margin could remain under pressure. Deposit growth overall, it's at 14.5% YOY and about 4% sequentially, in which the domestic deposit growth is just 12% YOY and about 2.3% sequentially. Domestic CASA ratio, first time below 40% in last 12 quarters, coming in at 39.88% when compared to 40.3% in the previous quarter. Overall, loan growth was at 17.5% YOY and about 3.5% sequentially, but domestic loan growth was weak on a sequential basis, a little less than 3%. In this, the retail domestic growth was strong at about 22.5% YOY and about 5.5% sequentially. X of retail, the loan growth on domestic book looked at 15% YOY and about just 2% on a sequential basis. So watch out for the net interest margin. The business momentum looks to be on the weaker side on a sequential basis in their domestic operations. Back to you.
All right. Thanks a lot for that, Abhishek, for that quick analysis. Well, let's hop across to Sudarshan. He had given us a heads up that MCX is likely to go live with a new trading platform. Sudarshan, back on yet again. Tell us more.
Good morning. Yes, CNBC-TV18 News Break is confirmed and MCX will be in focus today. The regulator SEBI's technical advisory panel has given the green signal for MCX to shift to the new platform. And as per the company, the panel has taken this decision after going through the submission made by MCX in regard to the complaint by Chennai Financial Markets and Accountability, which is known as CFMA, before Madras High Court. CFMA had raised technical issue in the platforms, and that case is now likely to be heard on November 29. Now, as per the disclosure by MCX, it seems SEBI's panel was satisfied by its response, and it has asked the company to submit go-live date of new platform to SEBI. Following this update, SEBI has withdrawn its September 29 order of keeping the shift to new platform in abeyance. Now we need to wait for MCX for the go-live date, and just for reference, I would mention here, MCX has an agreement with 63 moons till December 2023. And what I understand from my sources, it would keep that platform till the expiry and use it as a backup till then.
Okay, well, thanks very much, Sudarshan, for that. And Sudarshan, of course, stays on top of that story with more details coming up. Well, let's move on. Biocon is the next one in focus. Ekta has more details. Ekta, over to you.
Thanks for that. Well, yes, there are further delays in its biosimilar insulin aspart for the US market. So the latest news is the US FDA has issued a complete response letter, which is basically queries from the US FDA for the company's application for this diabetes biosimilar insulin aspart. Now, the complete response letter has not identified any outstanding scientific issues, which is a positive, but they have referenced requirements for satisfactory resolution of the deficiencies which were brought out in the inspection which had taken place in their Malaysian plant in August of 2022. The company had submitted a corrective action plan in September 2022. The agency had indicated they want a reinspection of the Malaysian facility, but it has not been scheduled prior to the goal date of October 6. So what that means is that basically the can is pushed down further on the road when it comes to an application as well as an approval for insulin aspart for Biocon. Hence, you could probably see red on the stock. Additional news, they've signed a partnership with a specialty company in Canada, which is for a diabetes drug. So maybe the news could probably be negated on account of that.
All right, thanks a lot for that. Well, let's hop across to Sonal now. She's going to give us the roundup of a couple of other stocks that are in the news this morning. Sonal, what's on your list?
Good morning, Sonia. 3 stocks on my radar today. Let me start with Prestige Estates. You're talking about Q2 operational updates coming out. It was a very strong one for Prestige. Their pre-sales were up 102% on a YY basis. Collections up 1%. Sales volumes were higher by 50% in the quarter gone by. And average realizations were up 29% as well. In the first half of FY24, they've done sales which are almost equivalent to what they did in FY23. So good show here. Solar Industries, well, the company has received the biggest ever order, which is worth 1853 crore rupees. This is from Coal India, and this is for supply of bulk explosives, which will be delivered over a period of 2 years. Similar is the story with GOCL Corp, because they've also bagged an order worth 766 crore rupees from Coal India. This is again for supply of bulk explosives, again for a period of over 2 years. So these 2 stocks will be in focus on the back of that.
All right, thanks for that, Sonal. Well, let's move to Manisha, who's joining us to tell us about the spike that we've seen in crude oil prices. Manisha?
Oh, well, thank you for that. 4.5% of a jump up is how we've opened trade for Monday. Remember, the prices did decline 8% in the previous week, but clearly the attack by Hamas on Israel over the weekend has been the reason for this. As of now, we do understand that this is all sentiment. There is no crude impact really, because Israel has 2 oil refineries with a capacity of total 300,000 barrels per day, which is not so much. And Palestine, on the other side, produces no oil and does not refine oil also. It is all about reports of Iran planning involved in the planning of all of these attacks. And Iran is a major oil producer. So if this escalates, if this spreads across more regions and territories, that is when you could look at the crude supplies getting impacted. As of now, we do know that there is no impact. There is no change in fundamentals as well. We do also know that Russia has allowed more fuel into the markets. The U.S. gasoline stocks are at 2022 highs. So all of that demand concerns are still into the market. This is a knee-jerk reaction is what the street believes into it as well. And at this point in time, we are still trading below $90 a barrel. But the markets do believe if the street starts to settle down by the time Europe opens, you could be looking at a profit taking as well.
All right, thanks a lot for that. So here is a quick recap of our top stocks with positive news flow. There's Reliance Industries, TCS, Titan, MCX, Prestige Estates, Solar Industries, GOCL Corp and ONGC, while stocks with negative news flow today, there's Bank of Baroda and Biocon. But there's also a long list of brokerage notes that have come through this morning. Sudarshan is here to focus on all that for the day. Sudarshan, good morning.
Good morning. In the brokerage corner today, we have focused on 2 sectors. First one is oil and gas, and second one is power. MS is written on oil marketing companies. It says September 2023 fuel demand has risen 5.8% year-on-year, led by industrial and transport fuel. MS believes overall diesel and gasoline demand continue to remain strong, and it sees strong outperformance with multiple catalysts ahead. Its key overweights are BPCL and IOC. HSBC has written on GAIL. It has a buy call and target is raised to 150 per share. It expects gas volumes to grow. It believes tariff growth, new gas marketing contracts, LNG volume, higher oil price should improve profitability. It estimates EBITDA and profit growth of 31% and 66% sequential growth in Q2. The last one is CLSA on power sector. It says power demand and execution have picked up, but earnings remain muted. CLSA sees a growth of 12% in EBITDA and 5% in profit in Q2. And amongst stocks, it prefers inexpensive, high dividend yielding regulated utilities like NTPC, NHPC, and CESC.
All right, thanks very much. So great getting that from you. We'll take a quick commercial break here. Prakash Devan will join in with some fundamental stock check. Lots to talk about this morning. We'll also be joined by the management of Healthcare Global Enterprises to talk about their acquisition in Indore. Stay tuned. Both those chats coming up.
Welcome back. Hope you're having a good morning. Well, for starters, the gift Nifty suggesting that we pull back a little bit. Global cues in a bit of a dizzy because of the Israel conflict. You have crude oil prices as well that have spiked up. But there are plenty of stocks to discuss. So let's welcome Prakash Diwan, who joins us to help us out with some fundamental analysis. So, well, Prakash, good morning and good to see you in this morning. Let's talk about Titan. You know, that came out with its update post-market hours on Friday. And the numbers look pretty good. I mean, Mangalam was telling us it came on a high base as well. Though Kalyan Jewellers, those numbers look much better, but that stock price as well has more than doubled. What's your view on Titan from here on?
Good morning, Nigel. Really nice to be on the show. You know, the Titan numbers tell you a very different picture than what expectations were building up. I mean, Kalyan Jewellers, of course, started tempering some of those expectations of muted, quarter, given the fact that you had this Adhik Maas impact. But the Adhik Maas seems to have actually added more business for some of the, verticals that Titan has, particularly the likes of Carrot Lane. So what I think these numbers tell you on a second order thought process is that given the way the company's expansion is happening, distribution is happening, there's a new segment that they have started catering to, which possibly is not very sensitive to these specific days and periods or months where not to buy jewelry or go out shopping. So interestingly, the trend towards buying high-end jewelry or gold particularly, and of course the fact that most of these companies have started becoming very significantly design-oriented rather than just the basic commodity orientation they had. I think Titan will probably be able to reset itself in a very different growth trajectory given its all-round growth from various verticals. I mean, I was happy to see even eyewear see such a decent growth. So as travel goes up, as people kind of start looking at that as a necessity and not just a luxury, things will change for them in the long run. Well, the stock hasn't fortunately done so dramatically well as some of the smaller ones have done in the jewelry space. But then it also has always been traded at a premium, so you would have to accept that. My sense is that the PEG ratio for Titan probably is looking far more reasonable than it did, let's say, 6 months or 12 months back. But at 3,300, you'd probably be not going to get rewarded so amply. So this is a stock that you buy on bad days again. It's definitely something which a lot of people don't have in their portfolio given its high value or the high premium valuations it trades at. But this is the time to accumulate companies like this for the long run for stable portfolio performance. But yeah, I mean, you could debate on the valuations, and some days you would get. So it's a Bajaj Finance, it's a Titan, whether it's a Reliance. All of these will have their share of valuation discussions and debates. But definitely, from a growth perspective, these numbers tell you a very different, robust picture emerging in the next few quarters.
All right. The other stock I wanted to discuss with you, and one, of course, that has been well identified by the street is Solar Industries, right? It's had a rollicking ride. I mean, 6 months back, Solar Industries was at 3,000. And today it's almost, 5,200. And there's this huge order that they've won, the largest ever from Coal India. So is there more scope on the upside, or do you think a lot of the run is done already?
Good morning, Sonia. So, I'm just hoping it's a coincidence that it is called Solar Industry, but it's not got anything to do with solar, which is doing so well otherwise. And this company has its own bottom-up, narrative that's kind of building up every quarter, every year. It's been, if you ask me, it's been highly valued in terms of, richly valued right from the time it was $1,200 about 4 years back, maybe 3.5 years back. But the kind of growth that people anticipated instead of coming from the defense vertical, which is one of the biggest where they've invested capacities, the orientation has been to cater to that segment. It's actually the conventional coal mining, this area where they've always been very strong at. Now, what Coal India this order tells you is that coal is not going away in a hurry. We've seen how coal has kind of responded to this entire situation, and the geopolitical crisis yesterday, it just makes it even more stronger as a optionality. And if that were to be the case, I don't see any reason why Solar Industries, with its footprint, which is so critical for the industry, to kind of lose anything. And what's happening is, if you look at the shareholding pattern, there's a lot of consolidation that's happened. A lot of retail have booked out, and a lot of HNIs and PMSs and institutional investment, and maybe not necessarily mutual funds, but a lot of the AIFs and PMSs have actually been accumulating this at lower levels. They won't want to kind of exit in such a hurry. So there's no selling that comes in, even on days when the market is a bit shaky. So I would believe this has a huge amount of resilience, and the growth starts probably helping justify the stretch P valuations. It is expensive. It will remain expensive. It's always been expensive. But again, I mean, this. We just spoke about Titan a few minutes back. This is similar to that. You have a market leader where you really don't need to kind of worry about growth anymore. And remember, the order size, if you see incrementally, I was just going through the last 5 orders that they've received, and all of them have been actually 20% higher than the previous one, which means in the last 5 orders, they've actually grown 200% approximately. So that's the kind of strength, and they have capacities to do it. So, yeah, you could definitely look at buying it as long as you're okay paying that stretch value.
So, all right, definitely look at buying it. But of course, there's valuations that you have to consider. Got it. Another stock I wanted to ask you about was Healthcare Global, but I'll come to you in a bit because there's some news flow there. Healthcare Global has acquired SRJ CBCC Cancer Hospital, which is a cancer hospital in Indore, worth about 44 crore rupees. The hospital has about 50 cancer care beds. To discuss this and more, we have B.S. Ajay Kumar, the Executive Chairman at Healthcare Global Enterprises. We had a chance to speak to him just a few weeks ago as well. So, Mr. Ajay Kumar, thanks a lot for joining in. I just want to understand how much have you acquired in this particular, how much have you acquired it for? What is the amount that you paid for this acquisition? And if you can tell us, what are the current financials of this particular hospital? What's the margins? What is the profitability? And what kind of occupancy are you looking at?
Yeah, thanks for having me. And, we did not have presence in the middle part of India. For us, it was very important to come to this part of the country. After having gone through a consolidation phase for 2 years, we have acquired the CBCC Cancer Hospital Indore. But it is 44 crores, but also there is an upside depending on how the performance is. Because post-COVID, there was some downside and we valued it at that level. But if the numbers increase as we have planned, we may have to pay another 14-15 crores more to the present owners. Under that agreement, our present payout is 44, but it may extend up to 60 crores depending on the performance in the next 12 months. As far as the hospital is concerned, it is very well located and it is about 70-bedded hospital with an occupancy of nearly 60%. So there is an ability for us to grow. And also it has got a full-fledged comprehensive cancer center. But more important is we also have an access to a new center which is being built by the present owner of the location. So there also we can expand and grow. So there's an opportunity for us under the agreement we have for further growth to happen even up to about 150 beds in the next 2 years. So this, I believe, is a great opportunity for HCG's vision of growth in this part of the country.
All right. Hi, Dr. Ajay Kumar. Good morning. Nigel on this side. Give us that number, right? If it has to go up from around 44 crores by 14 to 16 crores, what are those goalposts that you're looking at? If the financial performance improves, you said, in the next 12 months or so. So what is it at? And what is... yeah.
Essentially, what we are looking at is about the EBITDA to go to 6 crores. Right now, the EBITDA is around 4 crores. There was some issues in the post-COVID recovery and all. So valuation is based on 4.5 crores, which will increase to 6 crores, provided in the next 12 months, we are able to reach that 6 crores of EBITDA. If we reach that, the valuation will be top off at about 60 crores. It won't go beyond that. The floor is at 44 crores. And we do believe that this will grow to that level. And that is where we are headed.
Okay. Can you tell us just one final word on your debt? Your net debt is, I think, around 220 crores or so.
Yeah.
Do you plan to, raise funds to reduce your debt? And where will the debt be at the end of the next 1 to 2 years?
No, we are very comfortable with the debt to equity ratio and all. So in that, we don't see any need for raising any more debt. And we are quite cash positive in view of this. For the next few acquisitions, we don't intend to raise any more debt or get any more equity into the system.
All right. Any clarity from your PE partner, CVC, from the last time we spoke till now? Did you have a chance to have a chat with them?
Yeah, I've been having chat with them, but nothing really has happened. And if there is something, definitely, they will let you know about it in the near future. Okay.
All right. We'll have to keep an eye out on that. You're having a chat, but it appears not about the deal. But when you join us, maybe for your quarterly results, we'll try to get in a few more numbers. Thanks so much for joining in, Dr. Ajay.
Thanks.
Well, let's move to Anuj, who's joining us in the studio to tell us how he's reading trade setup this Monday morning. Anuj?
Well, Nigel, the thing that we're watching out for, of course, is the Israel conflict, and let's see how that impacts. Normally, geopolitical concerns are actually the best buying opportunities. The best example is Russia-Ukraine war. Of course, first of all, your heart goes out to what's happening there. But from the market point of view, that's a bit of a buying opportunity. Of course, we need to see if crude is behaving itself. That, I think, is something we need to keep an eye on. As long as the Nifty is holding 19,255, I think the market's okay. The technical risk for the market is a halt at the falling 20-day exponential moving average, which is something that I've been pointing out. We closed right at the 20-day exponential moving average on Friday, which is placed at 19,654, and we closed at 19,653.5. The market breadth was quite strong on Friday, so that's a bit of a positive. Now, as far as today's outlook is concerned on the Nifty, the numbers I'm watching out for, first support is 19,589, which is Friday's low, and the bigger support is 19,477, which is options based. So, I mean, if the Nifty takes a support there, that perhaps could be your signal in terms of, perhaps an opportunity. On the higher side, the first resistance is 19,655, which is the falling 20-day exponential moving average, and the bigger resistance 19,768. I think it's the Bank Nifty which you want to keep an eye on. The first resistance over here is 44,534, the 10-day exponential moving average. The bigger is 44,634, 20-day exponential moving average. Even the 50-day exponential moving average is placed at 44,686, and there's call options based at 44,600. So there's a sort of a cluster of resistance on the Bank Nifty. If you take that out, then expect a big rally, but that's not the base case right now. On the lower side, the support comes in at 44,125 to 44,243, and the bigger support is 43,830 to 44,000. Just an aside, my sense is today in the first half, IT will outperform for two reasons. A, crude's gone up, so that's a bit of an algo trade, plus the TCS factor. But if the market has to recover, then in the second half, it's the Bank Nifty which has to take the lead. So let's see. You want to divide the trade in two halves today and see how the market's reacting and then take a call.
I think with IT also the thing, Anuj, is that the stocks have already run up quite a bit. So perhaps anticipating that this earnings season may not be as bad, maybe commentary can pick up, right? That's the narrative too.
Sonia, IT actually bottomed out in April, which is when you had the worst earnings. From April, when you had the Infosys shocker, the two stocks which have done the best are actually Infosys and TCS after that gap down. And the best sector has been IT. So in some sense, the market sort of moved on. Though TCS itself is now above its own median valuation, I think Infosys is almost getting there. Mid-cap IT is already there. So yes, from the risk-reward point of view, perhaps it doesn't make sense. And in any case, buyback provides a floor and not really a trigger for the rally. Let's see how it moves in today's trade.
That's well put, Anuj. I mean, maybe, the earnings season, by the way, is not expected to be great for IT services, right? But the TCS, at least for that stock, the buyback provides a bit of a support, bit of a floor there that we won't see large cuts or anything. That offer is there. Anuj, thanks for that. We'll take a quick commercial break here. Mitesh and Sudarshan are with us with a quick technical trade setup. That's coming up in just a bit, and we're about 10 minutes away from the pre-open session. Welcome back. 9 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with a quick check on how they are seeing things develop. Gentlemen, good morning. Good to have both of you here. Mitesh, how are you looking at the Nifty to begin with? You know, from the lows of last Wednesday, the Nifty is up 300, the Bank Nifty is up 500. On the trot, both Thursday and Friday, we saw 100 points each. So coming into this week, just purely from price action perspective in a constructive kind of way, but is there enough in the box to power ahead? Or do you think it's cloudy from here?
Morning, Prashant. I think the bias is slightly on the positive side. Not only post-Wednesday we saw 2 good days, but on both the days we had a gap up opening, which was not attempted to, the markets did attempt to fill the gap. So that's a very positive side. Though, of course, there are pivots at higher levels, and 19,720 for me remains an important level. So maybe I'll aggressively bet long on the index once we start getting past 19,725, and then look at a test of 19,850, 900 zones again, and then maybe even further up. But for the timing, I think trading should be clearly biased on the long side. So even if we're not trading the index on stock specific side, we're trading with long bias. The Bank Nifty also is at a very critical support area of this 43,800 levels. We bounce back from there on Wednesday. So I think, unless until that level gets broken, I think there is a chance of Bank Nifty also experiencing some kind of a up move purely as a rebound to the decline which we saw a couple of weeks back.
Right, Sudarshan Sukhani is also with us. Sudarshan, what's your view? Do you think that the dip that we get this morning, whatever it is, should be used as a buying opportunity? And what are the stocks to look at?
Yeah, good morning. I think you're quite right. See, the market has given a reasonably decent buy signal on Wednesday when it bounced back from a lot of lows. And then the gaps which Mitesh has referred to. So I would think that today is a buying opportunity in spite of the fact that we may open weak and there is a sense of weakness all around. I mean, at least in the news. But this is a buy. So for the Nifty, now there is no precise point where you can buy. So you wait patiently for whatever morning decline comes about, put a tight 100-point stop and go long once you see some kind of stability. But the same cannot be said for the Bank Nifty. The Bank Nifty charts are much choppier as compared to the Nifty. So just focus on the Nifty.
Okay, all right. Buy on dip seems to be the trade that we're looking at early this morning. But let's talk about individual stocks. Mitesh, you go first. What are the individual stocks you're looking at?
Morning, Nigel. I have more of buy calls today, in line with my opinion that the markets may be recovered fast from the gap down opening, which we are likely to see. So I have a buy on L&T Finance, which is a buy with a stop below levels of 135 for a target of around 144, 145. A buy on DLF, which I would want to buy on this gap down on mildly lower levels than yesterday's close. So around 545, take a long position. Keep a stop below 535 and 565, 570 is the first target zone. And also a buy on GMR Infra, recommending to buy here around 61.5 levels with a stop below 59.75 and a target of around 65, 66 can be looked at. And one sell call, that's on IDFC First Bank. Keep a stop about 93.5, look for targets of around 87.
All right, and Sudarshan, what about you? What would your stock ideas be?
Well, it's a little mixed, given that there will be some weakness, I assume. So Voltas is a buying opportunity, a very mild correction after a big up move and probably a resumption of the up move. Stop loss under 860. SRF is going through a deep correction. That's an intraday short with a stop above 2280. India Mart is going through a similar deep correction. It's in the F&O list. So you have an intraday short here with a stop above 2905. And finally, Ipca Labs has a very attractive trading range after a big up move. That range is now on the verge of breaking on the upside. It's a positional trade. It's an intraday trade. Buy with a stop under 920.
Okay, all right. Let's do one thing. Let's take a short break. We'll come back with the pre-opening rates. Also will be with us Manish Raj Singhania, the president at the Federation of Automobile Dealers Association, to put focus on the auto sector to get a quick snippet on how demand trends are shaping up. Stay tuned for that. Well, let's get a quick grip on what's happening in the F&O market this morning. Chandan Taparia is joining in. He's the derivative and technical analyst at Motilal Oswal Financial Services. Chandan, hi, good morning. What are your thoughts on how to approach this, crack if we do see it shape up? And what are the stocks that one should be looking at?
Good morning, Sonia. Thanks for having me. We have seen some recovery in the indices from lower levels in last 3 days. Nifty made low near to 19,333, managed to recover to 19,650, but momentum is clearly visible. Momentum is clearly missing in the market. We have noticed that we witnessed recovery, but follow-up is not there. Selective stocks are doing well. Bank Nifty is not performing. And now again, the concern from the geopolitical may keep the kept upside in the market. But it feels that selective stocks will do well. So that is why I'm not expecting major decline in the market. Declines could be bought, and we are likely to be in a broader range in between 19,442 to 19,800 zone. So buy on decline stance could continue to be in the market, or is likely to be consolidative for the next couple of more days. Looking at Bank Nifty index, here's some slight mixed view. Multiple hurdle is near to 44,500, 44,750. So need to surpass the zone, then only some sort of strength will be there. Otherwise, we can retest the recent low 43,850, 43,600 zone. So need to deal with the indices in mixed view, but comparatively because of few heavyweights, Nifty may hold the lower zone. Now looking at the stock wise, going to be with the selective stock which are holding the strength. So first it is buy on Titan. We have seen good recovery in the counter from 31.15 to 33.20 levels in last 4 days. It managed to again recover its 50-day exponential moving average, and geopolitical concern will keep the gold prices to higher zone. That is positive for the gold related companies. So recommending to buy on Titan with a stop loss of 32.50 and a stock can head towards 34.50 level. Second trading idea, that is buy on Indian Hotel. We suggest to go with buy on decline as it has negated lower lows on the weekly chart. Most of the hotel companies are doing well. It has given a decisive hold above 415, 420 zone. Some sort of a delivery based buying is there, which will continue to keep the buy on decline stance. So recommending to buy with support of 415, stock can head towards 440 level. Last trading idea, that is buy on DLF. Nifty realty counter is doing well, and most of the stock has given a breakout. DLF has given a consolidation breakout of last 18 days. So with support of 540, it can head towards 570. So we'll go with selective stock specific buying with support on Nifty near to 19,440 zone.
Okay, all right. Thanks a lot for that, Chandan. Wishing you a good day ahead. Well, let's get back to our chat we're having with Prakash Sivan. Prakash, last couple of questions before we let you go. MCX is the big mover in the first couple of minutes of pre-open, because finally they're going to be going ahead with the new platform. What's your view on the stock? It's likely to open gap up. What would you do from here? The market capitalization now is more than 10,000 crores. So it's looking actually on a valuation front a little bit expensive. Your take?
Yeah, absolutely right, Nigel. So we kind of spoke about this, that the trigger for MCX to start consolidating or getting into some favorable territory is the rollout of the new platform. I mean, we've seen them incur a huge expense, which has impaired their P&L for sure. But you'll have to also wait for this to be rolled out and see whether it kind of helps them get back those volumes that we've always built around the MCX narrative. And remember, the BSE launch of a lot of commodity derivatives is a big, threat. It's not something which you could take lightly, given the fact that it already has a significant presence and it's making that kind of, options salience that it has started seeing in the last few months roll out to the commodity side as well. So my sense is MCX, it'll be a while before MCX starts getting to be well established with this new platform. So any pop that you get on the back of this sentimental, news flow in terms of a relief could probably be a good opportunity to book and then kind of re-enter after assessing the situation. But going long at this point immediately, I think it'll be a long wait. So I would not recommend.
All right, Prakash, thanks a lot for joining in. Have a good week. Thanks for stopping by. Let's just address a couple of stocks. The pre-opening rates are settling down about 90 odd points. So it looks like the global development is something that could have its effects on the pre-opening rates. A couple of stocks, TCS on that impending buyback is up 1.5%. Prestige Estates on the very strong business update is up about 3 odd %. We'll keep telling you about these stocks as and when we move along. But let's shift focus to the big global development. Israeli Prime Minister has declared war in response to the attack by the Palestinian militant groups over the weekend. This is the worst assault on the state of Israel in over 50 years. Prashant is standing by at the wall to decode what this means for the markets. Prashant.
Well, thanks very much for that. Tragic developments with the conflict erupting in the Middle East over the weekend. The Israeli Prime Minister Benjamin Netanyahu on Saturday said that Israel was, and I quote, going into a long and difficult war in response to the unprecedented attacks by Hamas on Israel. US President Joe Biden has also pledged, and I quote, rock-solid support for Israel. But for right now, for our purpose, let's look at how markets, financial markets have responded during periods of extreme tensions between Israel and Palestine. Let's look at the most extreme periods, right? And we're looking at data going back the last 20 years. And I want to start with the second intifada, which intifada is an Arabic word which kind of refers to uprising, rebellion, etc. This lasted a full 5 years, which saw escalated violence that ended with the withdrawal of Israeli forces from the Gaza Strip. The first one, of course, was in the late 80s, running into 90s, the first intifada, so as to speak. The second one, these are periods of tension/conflict, was in 2008, December 2008 to Jan 2009. That lasted a full 22 days. There was a 22-day conflict. It was, very intense, but it was short-lived in that sense. And also, this happened during, the period of global financial crisis linking into the markets. Let's move on to the next one, which is 2014, which was between July and August. This was a longer conflict as compared to the previous one, and this was a 52-day conflict, which we actually saw. And then you'll have to come back all the way to a more recent one, which is May to June 2021, which is known as the Gaza War. This was an even briefer one, the briefest of the ones that we're looking at, and this lasted all of 11 odd days or so. Now, for our purpose, as I said, we are looking at, what markets have done, right? I'm only looking at market reaction during two instances, 2014 and 2021. The first one, of course, we don't know, right? From 2000 to 2005, will this one last as long? We don't know. So we've kind of kept that aside. And how do you kind of sort of look at, you can't look at market reaction over a 5-year period. So that's been kept out. And the second one happened during the global financial markets, a global financial crisis, the GFC. So, there were other impacts as well which were weighing in. So it's kind of hard to isolate the impact of exactly the conflict here in the Middle East. So as I said, for the purpose of, this particular exercise, 2 episodes, July to August 2014 and May to June 2021. Look at this. US equities down about 5 to 5.5% in both these episodes. US 10-year yield down 22 basis points and down 20 basis points. Basically, it's a sign of risk off, right? Clear sign of risk off. Oil is a little mixed, but I'll tell you why. Crude oil down 12% during 2014. But remember, in May, June of 2014, oil had hit almost $120 a barrel. So it was coming into this particular conflict at a very, very high level. And then during the course of this particular conflict, it fell about 12%. The 2021 May to June period, oil prices went up 19%. That was a very substantial jump that we saw. And of course, Israeli equities, which are of course most impacted, 3.5% and 9% cuts there. The point is that market reaction actually has been meaningful if you look at equities, if you look at yields, and if you look at oil prices as well. The hope is that this conflict sees de-escalation quickly. But just this morning, the Wall Street Journal, the newspaper, cited senior members of Hamas and Hezbollah saying that Iranian security officials helped plan the attack. So there is Iran in the mix as well. The risk really is that the conflict could escalate into a more severe proxy war. Let's hope that is not the case. Back to you.
Oh, absolutely, Prashant. Thank you for putting that into perspective for us. It's not looking good at all from any angle that you look at it, right? From an economic standpoint, from a humanitarian standpoint, we hope that peace, prevails over what's happening. As of now, of course, the death toll has exceeded 1,000, and I think 6,000 people have been injured so far. So looking like a very gruesome situation at the moment. But let's get back to our own markets because we have a market to trade. The pre-opening rates have actually settled much lower, down about 114 odd points. This is the Nifty hanging at that 19,500 mark. It is clearly geopolitical tensions that's dragging the markets this morning. If you look at the top losers, Adani Ports, BPCL, Asian Paints, Adani Enterprises, Sun Pharma. So it's a secular run on the downside. What's batting for the bulls perhaps is ONGC because of that move that we've seen on crude and TCS on the impending buyback. But let's do one thing. Let's shift focus. There is some data that has come through from the Federation of Automobile Dealers Association, where they talk about how the month of September has seen a very strong growth year on year. And it's a double-digit growth of 20% that the industry has seen in the month of September, except for tractors, which witnessed a 10% degrowth. All other categories saw good growth. And the two-wheeler space, especially the mass market segment, has finally come back to life with a 2% growth that we've seen. Manish Raj Singhania, the president at the Federation of Automobile Dealers, joins us now to talk about that. Manish, this of course is, backdated information, right? September is now behind us. Tell us, what is the way forward? What are the big trends that you notice in the month of October?
So overall industry has been doing pretty well. And the segment that we were most worried about was two-wheeler. And that has also been, performing pretty well since the last month. So as a dealer community, as dealers, we are pretty optimistic about the upcoming festival season. And we already saw in September passenger vehicle creating an all-time high for the individual month of September. So every month a kind of a new record is being created for auto retails. And we have also seen consumers coming out during festival seasons with all their savings and really encashing on their muhurats and auspicious days to buy vehicles. So overall, we are expecting a very and overall 95% of the monsoon has covered well across India, and with a decent crop also, everything good seems good for the upcoming festival season for auto industry.
So you said that the two-wheeler segment, which was most concerning for dealers, has now started to improve, right? In your note, you do mention that there's a 2% growth that we've seen for the two-wheeler space in the month of September. Is this the growth rate that you're expecting even in October and November, a low single-digit growth? Or do you think at some point we could get to double-digit as well?
So definitely we are expecting a double-digit growth in two-wheeler industry. Last time also two-wheeler wasn't doing that well. And we could see continuous stress in the rural market, and rural pockets were not performing well. But in the last festival also, what we observed is that Indian consumers definitely came out during the festival time to buy vehicles on their Muhurat days and auspicious days. So that similar kind of activity we are expecting this time also. And we have a tendency that we have seen a tendency that Indian consumer kind of accumulates the funds for buying vehicles during the festival time. So definitely we see both the urban market as well as the rural doing well. And with the rural performing well, we could see some improvements in the entry-level passenger cars and two-wheeler both.
Okay, that was my next question, right? Entry-level passenger cars, the affordable segment. Do you expect to see a recovery? Have you seen any major signs of a recovery there, A? And do you expect that to continue? Are we looking at a double-digit growth there as well? Because that's not the feelers that we get from the passenger vehicle manufacturers yet.
So we are not saying that that segment is recovering or would be growing, but definitely we see a definite momentum happening during festival times. So it has been stressed, and the market has shifted to SUVs, especially feature-rich SUVs are being selling in the market, and it is now capturing almost 52-53% of the total PV space. So the kind of stagnancy that is there in entry-level market, that will see some momentum happening during festival times.
Okay, just one final word. The only segment that has refused to perform, or rather that has been under pressure, is tractors, right? It's a 10% degrowth. Agreed that there was a lot of volatility in the monsoon that perhaps affected tractors as well. But your take on whether things can improve in the months to come, and what is the growth rate that you're looking at?
So tractors, we have already seen that it has peaked quite high. It has given already huge numbers, retail numbers. And the sowing season is over. The primary use of tractor is during the sowing season. And the tractor industry has been doing very well last year, and it was an all-time high figures. And matching those figures consistently and or kind of crossing in every month, that would be seem to be a bit difficult. But tractor has also seen, apart from agriculture use, as a means of employment for the rural India, and especially for the migrant people who have migrated to their villages during COVID times. So that had fueled the growth of tractor industry. So it was at all-time high level, and some corrections is bound to happen in tractor industry. So I think this number is still quite a decent one.
All right, Manish, always a bearer of good news. Thanks a lot for joining in and talking about the industry, which is on a path to recovery. Good double-digit growth is what he's expecting in the two-wheeler space, which has come back after a long time. So that's perhaps a space to look at. But in pre-opening, we have restricted our losses to about 115 odd points. Couple of stocks that are bucking the trend this morning. Prestige Estates is up about 5% on the back of very strong business update. Solar industry is really stock of the year, if you want to call it. I mean, big growth coming through this year and largest ever order from Coal India for solar industry. So keep an eye out on that. And a couple of others like TCS also in focus. But let's get Mitesh back on board. Mitesh, your thoughts on how to approach the market opening and any stocks in focus now?
Yeah. So I think, the Nifty might open closer to about 19,550, which if it doesn't fall or if it stops to fall from there, I would want to take a long with a 30-40 point kind of a stop loss. And on the stock side, DLF is what I recommend. Buy with a stop below 535 for a target of 565 to about 570.
Okay, bang on time. Thanks a lot for that. Let's head straight into the market opening, which is expected to take a knock because of what's happening, across the globe. The first tick on the Nifty coming through with a cut of 130 points, not looking good. The sensex is down about 500 odd points and the Bank Nifty is down about 400 points. Straight off the back, the advanced decline ratio is at 1:5 in favor of the decline. So the market is clearly quite perturbed with what's happening across the globe and a sell-off coming through. Adani Group stocks are under pressure early this morning. Adani Ports, Enterprises down about 1 to 2 odd percent. BPCL is down about 2%. A lot of these crude sensitives are in focus this morning. Asian Paints is down about 2 odd percent. You have Sun Pharma that's down 1.5%. Tech Mahindra, Hindalco, SBI. So, it's across the board actually. All stocks on the Nifty except 3, ONGC, HCL Tech and TCS. Barring these 3, all stocks are in the red. TCS, of course, because of that buyback. ONGC because of the way crude is moving. And HCL Tech comes out with numbers this week as well. So do keep an eye out on that. The other couple of stocks that you'd want to look at from the heavyweights, some of these pharma names are under pressure. So Sun Pharma, Apollo Hospitals, etc. are trending in the red. But weak opening for the market. The important bit is now, right? Whether the dip gets bought or whether it accelerates further. Time will tell, but for now we have restricted our cut to less than 150 points.
Well, that's right. Sonia, so the GIFT Nifty was suggesting 40-50 points odd, which wasn't looking very appropriate. But I think 140, 150 point for those that wanted to go ahead and buy the Nifty, well, this would be on their wish list, and you'll have to keep a stop loss of closer around that 30 points or maybe 19,470 should be that important level that you should hold out for those that are looking to buy the dip. But stocks in focus. You have Titan that's under some pressure. The stock is down close to 100%. Tata Steel as well is taking a cut of close to 100%. And Abhishek told us that Bank of Baroda's numbers weren't so impressive. So that one as well is opened up with a cut of more than 1%. With regard to Titan and Tata Steel, I think it's more with regard to what's going on with the markets because those numbers were more or less in line. No big disappointment out there. Prestige, the quarterly update looked quite good. The stock opens up with a gain of close to around 2%. MCX, they're given the green signal to move to the new platform. So that's why that stock, after gaining close to around 4% in Friday's trading session, is still up close to around 2%. Order wins, you had Solar Industries that won an order, a large order. So that's opened up well in the green. You have GOCL, they as well won an order. So GOCL as well should come up for you in the screen. And RVNL as well, that's the other one in there that had, won an order. So that stock as well opens up well in the green as we speak. Some of these PSU banking names are taking it on the chin. PNB and Union Bank, both of them under some pressure, down between 3 to around 4% odd. OMCs are taking a hit because crude oil prices have spiked up. So you have HPCL that's on close to around 3% odd. In the green, you have Oil India. Crude oil prices moving up. Good for ONGC, good for Oil India. So both of them bucking the trend, up 1.5%.
Well, 140 points is what we have in terms of a cut on the Nifty, just at about 19,500 at this point in time. So, yeah, there's a lot of stuff coming up straight off the bat. IRFC is down about 3.5%. Some of the bigger volume-led losses that are coming through. I think we've got, cuts coming through in, I think, Union Bank we mentioned. But there is other stuff as well. For example, Indigo, if we can have that up, which I think is coming up with a 3.5 odd percent cut, almost I think 4% cut at one point. But there is, things are changing around fast, so we'll have to give it some time. But volumes are also picking up. Suzlon is down about 4% or so. Stocks at about just under 28. That did very well recently. Cochin Shipyard is down about 2.6%. Kalyan Jewellers, I think, saw a very large move on Friday. It's doubled this year, 2.25% lower on Kalyan Jewellers, 252. Ircon is down about 3.5-4%. So some of these railway stocks are coming up with some cuts. Utkarsh, Small Finance Bank, that is down about 3.5%. Again, something that has done well recently, and especially on Friday as well. So yeah, I mean, there is some red on the screen. Market breadth, of course, is skewed in favor of declines. At least that's the way we are starting at this point in time. MCX, as both Nigel and Sonia highlighted, 3.5% up right now. Prestige, you'll be hearing from the management a little later in the program. Stocks up about 2.25%. Supreme Industries is up about 2%. That's just under 4,000 rupees on Supreme Industries. On volumes, HCL Tech is coming up with a 1% gain. Solar Industries, there was a large order win, 2% higher on that one. And there is Fortis, which is coming up with about a 1% odd gain as well. Maybe look at Keynes Technologies as well, which is up 3%. So, yeah, I mean, there is some 300 stocks which are higher as opposed to almost 1,700 stocks which are lower. Sonia.
By the way, I just want to make one mention on TCS because the stock has hit a fresh 52-week high today ahead of the buyback, right? And of course, a buyback is a positive signal, but Morgan Stanley has put out a very interesting note where they say that out of 15 times, about 10 to 11 times the stock performances getting into the buyback is much better than the performance post the announcement. So, you don't want to chase it from here on because history has taught us that post the announcement of the buyback, the stock actually comes under some pressure. I mean, the last 3 times the buyback was done, there was a fall of anywhere about 1 to about 5% post the buyback. So maybe a lot of the news could have been in the price.
Absolutely. Well, keep an eye out on that one. 0.5% higher for now. Our market master of the day is Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company. Nilesh, good morning. Great to have you with us here on the program. Thanks very much for your time. Nilesh, you guys were at Kotak have been the first to kind of sound the alarm bells for, the broader markets. And I think so many sort of, at least on the sell side and even on the buy side, have followed since. Almost a bit of a consensus view now that this is the time now, at least for the rest of the year, for large caps. We had Pankaj Tibrewal with us on Friday, and he was making this point that the median stock return for mid-cap and small-cap stocks in the month of September actually turned negative for the first time after a long while. Do you hold on to that kind of line of thinking, Nilesh, that there is more to go here, in terms of either time correction or price correction for that part of the market?
Undoubtedly, yes, Prashant. Today, small and mid caps are expecting 10 out of 10, in terms of performance. And there are dark clouds gathering on horizon. Oil prices are likely to head higher after what happened in Middle East. US interest rates are likely to remain higher for longer. And rural recovery could get impacted because of uneven distribution of monsoon. All these things would not have mattered much if markets were not expecting 10 out of 10 in terms of performance. Obviously, at this point of time, we believe there is more margin of safety in large and larger mid-cap and less margin of safety in smaller mid-caps, small caps and micro caps and mini caps. Normally, the valuation should decline as we move lower on the market cap curve. Unfortunately, at this point of time, many of the smaller companies are trading at a higher valuation than larger companies, which is unlikely to sustain for long. The good part is that earnings are also growing at 1.25% a month. So there could be combination of both time and price correction than just price correction.
Nilesh, hi, good morning, and thank you for being on the channel. It's very unfortunate to see the humanitarian crisis that's unfolding in Israel at the moment. But history has taught us that every geopolitical crisis has been one of the best buying opportunities for retail investors. Should one buy the dip this time around as well if things escalate further?
Undoubtedly, Sonia, India is a longer-term growth story, and our earnings, at least for the foreseeable future, are expected to grow anywhere between 1% a month to 1.5% a month. That's growth rate of anywhere between 12 to 18%, depending upon what kind of portfolio you have picked up. As long as this earnings growth trajectory continues to remain, I think every correction is an opportunity to buy. Apart from earnings growth, we also have to focus on two things. One, governance standard. Today, Indian governance standards are more comparable to Western world and far better than emerging market peers. We get premium valuation because our governance standards are at a premium. And third thing which we should market to the world is our green commitment. Many of our emerging market peers are not part of COP26 declaration. Many of the developed markets are not on its way to achieve COP26 commitment. India is one of the few countries in the world which will achieve its COP26 commitment, and we continue to remain the lowest per capita carbon emitter in the world. This 3G of growth, governance, and green is something which will keep investors focused on India, and hence every correction is a great opportunity to buy.
Hi, Nilesh. Good morning. You termed the RBI policy at a couple-day kind of policy. They're watching the pitch, they said, and it's turning. They'll play every ball on merit. Tell us more about that. What was your reading of the RBI governor's speech on Friday? And, some part of the street was hoping that we'll see rate cuts. But that's likely to have got pushed back a little bit. Give me your comment on that.
So, Nigel, Kapil Dev could ball, bat, field, and also captain. Yeah. The RBI is also like Kapil Dev, managing rupee, inflation, GDP growth, financial sector stability, and most importantly, government's borrowing program. And hence I compared that this policy is like Kapil Dev policy, tackling everything. They are keeping everything in equilibrium. Now, market was expecting some sort of guidance on how foreign portfolio investors' demand on debt side will be absorbed. We expect about 20 billion plus passive flows and 10 billion plus active flows. That kind of money is going to have an impact on Indian bond market, and markets were looking forward to RBI's guidance on the same. On the other hand, RBI announced open market operations to take away liquidity. And liquidity was turning negative on some days because of GST tax outflows. So this was a bit of a shock to the market, and hence yields have hardened a little bit. But overall, RBI has done a fantastic job in managing conflicting objectives from growth, inflation, rupee, government's borrowing program, and financial sector stability in control. And no wonder RBI governor got the recognition as the best central banker of the world.
Nilesh, just absolutely well taken, those points. We saw a very large move in bond yields on the 10-year on Friday, almost a 13-14 basis point jump in the India 10-year. And this morning, yields are flat, which means that they're holding on to those levels, about 7.34 or so. Any thoughts on this, and any implications for financials, NBFCs, etc.?
So I do know that in the second half of 24 and first half of 25, yields will come down from whatever level they are today, because one, foreign portfolio investor buying will emerge of about $30 billion plus, and there will be rate cuts by US Fed somewhere in middle of 24. It's the journey from here till middle of 24 which is likely to be choppy, and with little bit of upward bias because of Fed's option of keeping one more rate hike. Now, this will have impact on all those NBFCs and banks which does not have liability mobilization. Any bank which has access to CASA balance and deposit mobilization at a cheaper rate will do well. Any bank or NBFC which does not have access to cheaper cost of funding, they will be in trouble. And we have already seen banks and NBFCs whose deposit mobilization is not strong. They are not participating in this rally. PSU banks by and large have access to rural hinterland, and that has given them tremendous deposit mobilization capability, and that is already reflected into their prices.
All right. By the way, the sell-off has accelerated, so it's getting worse now. The Nifty has given up on that 19,500 mark. The sensex is down over 500 points. So the market has been trading lower since the start, and it's only getting worse as we speak. Nilesh, I wanted your thoughts on IT because that's the big thing to watch out for. The earnings season kicks off this week with TCS on Wednesday. The narrative is that things are going to improve, and they have improved, right? The worst perhaps is behind us, and that is the kind of commentary that people are expecting. If you just go by what stock prices are doing, what is your own estimate this time around?
So my feeling is that in terms of results, there will be case-specific stories, but overall general disappointment. We haven't seen sales conversion cycle happening at a faster pace. There is some positivity on cost as work from home has moved to office environment, and the bargaining power of employees have come down as recruitment has virtually stopped. I believe over the last 2 quarters, there's no net addition to IT workforce, and hence bargaining power of employees have come down. So there is less of a cost pressure, but there is a pressure in terms of volume and in terms of sales cycle. I think market has discounted that the September quarterly results will not be as attractive. Everyone will be interested in knowing what is the future. And this is where we believe companies which will be able to lay a roadmap that by using machine learning and artificial intelligence, they are able to provide cheaper, faster, better solutions to their customers. They will start getting differentiated vis-a-vis other peers. Every IT company is into AI and ML, but they have to prove that they are better than the peers. If companies are able to convince markets on one, sales volume growth, and second, their ability to leverage AI, ML to create faster, cheaper, better solutions for customers, those IT stocks will be outperforming.
Nilesh, a viewer / I'm assuming a Kotak unit holder messaged me saying that Kotak has introduced something called a new initiative, a digital card yesterday. And you wanted to know more about it. I mean, briefly, could you explain?
So it's not Kotak Mutual Fund initiative. It's the initiative of professionals in the industry. Deepak Mundra has been leading it, but myself, Navneet Munot, Anil Singhvi and Sailesh Lodha have come together as a mentor. Essentially, we are trying to protect environment in a very, very small way. We are replacing business cards with a digital card. There is an app called Save Tree VC available on Apple and Android. Anyone can download it for free. It will take care of your business cards. Na card lenge, na card lene denge.
That's wonderful. And congratulations for that initiative. I'll try that out. And so will all of us here at CNBC-TV18. Thank you very much, Nilesh, for that. Appreciate it. Nigel.
All right. Well, just a quick word on the markets. Then, the Nifty went down to around that 19,480 approximately. And we're bounced off that level. So we're at around 19,530. Remember, the gash was far deeper than what the GIFT Nifty suggested. But as we suggested earlier today, the highest open interest is at around 19,500 put. The premium at the start of today was close to around 35 rupees. That's more than double. But that's going to be an important mark. 19,450, 19,470, crucial support zone for the day. So just keep an eye out on that mark. We're bounced 50 points from the day's low. Let's move on then. Hotel stocks. Well, they're in focus in light of the Cricket World Cup, which is being played in 10 stadiums around the country till November 19th. To discuss the demand trends as well as the occupancy trends, Mr. Puneet Chatwal, the Managing Director and Chief Executive Officer at Indian Hotels, joins us on the show. Good morning, Mr. Chatwal. Always good to have you on the show. Well, since we're talking about the World Cup, could you give us a sense what proportion of your overall keys gets benefited from this G20 as well as the World Cup, a proportion of your total number of keys?
Well, Nigel, good morning. I think there is a big benefit in all the cities that the World Cup is being played, especially on the dates when you have important matches, or let's put it this way, when you have favorite teams playing out there. There is a big increase in occupancy and in rates. But having said that, I think the sector per se is very well positioned in the short, medium and long term to experience this upcycle that we started a year and a half ago and keep that momentum going.
Maybe it's because of World Cup, maybe because of G20, but more importantly, a variety of reasons which I'm happy to discuss with you.
Sure. Please go ahead, Puneet. What are those reasons? And if you can tell us, what is the monetary implications for, say, a company like yours?
Sonia, let's first talk about the sector. I think the short-term benefit is coming through demand, which is outpacing supply. Not much supply got added during the COVID time. The demand has come back. And I think the demand outpacing the supply will make the sector perform well. On the medium to long term, the investments in the infrastructure, as we all witnessed, the Bharat Mandapam in Pragati Maidan, and now the convention center in Dwarka, or be it the Geo Center in Mumbai, all this is creating new sources of demand that were non-existent before, because we had no possibility to host up to 5,000-6,000 people in a single room in India. So I think going forward on the medium term, the infrastructure investment in convention centers, the infrastructure investments in the new airports, the infrastructure investments in the new highways creates a very good base for the hotel sector to benefit. And on the long term, one of the key a catalyst for improving rates and occupancies in this sector is the GDP growth. And the GDP growth is expected to be stable, which means higher per capita,
Puneet,
which means higher discretionary spend.
Sure. That overarching theme is, I think, well documented. I just want to understand if you can tell us what are the exact rates that you're getting this quarter, and if you can compare it to the average of, say, the last 3 to 4 quarters, just trying to understand the scale at which, the rates have gone up.
See, there is a double-digit growth that we have reported in Q1. And talking to our colleagues within the Hotel Association of India, within the CII National Committee on Tourism, the rates and the general revenue trends is definitely with a double-digit increase. With the wedding season and the Saya dates, coming around the corner, the festival season, coupled with the World Cup, we see no reason why this trend that we witnessed in the last year should not continue in this year. There is nothing that makes us believe, including business on the books, that we share within our fraternity.
Puneet, hi, good morning. Prashant here. That point about the convention center, etc., is absolutely well taken. Anecdotally, I have a friend who's in the pest management business, and there's a World Pest Control Conference which happens. I was surprised when I first heard about it. It's happening in India, I think next year for the first time, and it's happening here in Mumbai. My friend was telling me that it's thousands of people are going to come, and now that we have this, for example, as you mentioned, the Geo Convention Center, it's possible to host these things. The irony is that the place was booked out, so they're doing it in Mumbai but somewhere else. But point taken, and I think it sort of bodes well for occupancies, ARRs, etc. But is that a big one? Because Mumbai also is a high sort of room rent market, right? For you, is it a structural kind of positive which will kind of added a couple of basis points every year as compared to when this was not there earlier?
Yes, Prashant, very right. Mumbai is the most important market for the hotel sector in India because it is the commercial capital. Now, with the support that we are getting from this one-off events, which will be, a lot of them will be India's first, industry first, being hosted in India over the next several years. I think that the hotel sector is very well positioned to benefit from that. And as Sonia asked in terms of rates and occupancies, of course, we are coming from a very low base. So experiencing 10, 12, 15, 17% increase is still at a very low level. It's, sub $200 in luxury sector. So I think on an average, I'm not saying for Mumbai, so I think there is still room for growth, and we will witness that growth in the next quarters and years to come.
Puneet, I just wanted you to clarify on this. Some of the stadium visuals we got, they were indicating the stadiums are not very, very full. It's a little bit worrying, right? And there's a big debate going on online as well. With regard to hotels, you're chock-a-block in most of those areas which are hosting matches?
Nigel, it's a very interesting question. First time when I saw that on the opening match, even I got a bit worried. But, it's not with the occupancy rates just of the stadium. It's all the people who come with the teams, the whole entourage, and all the other activities which happen with the press and the post-match parties and events. I think all that together boosts the rates and boosts the occupancies. And as and when we progress further into the middle of this month, let's say 19th of October till 19th of November, as you said in your opening comment, the momentum will keep going up.
I think that has been, it's all over the internet, right? That the stadium was absolutely, was largely empty in Chennai. So these questions are pertinent as to where are the seats going and where are the tickets going and what's happening.
Look at it yesterday, it wasn't empty. It all depends on which match, which stadium, which date. And I think as much as the first day was like a bit of a shock, yesterday was much more than a relief, including India winning.
Absolutely. Okay, let's talk about your own business then. In Q1, your margins saw a bit of a dip, right? As things are opening up, as costs are going up as well, do you think that there could be a little bit of pressure on margins? And what is the ballpark rate that you're looking at in terms of margins?
Sonia, we have given a guidance under Avan 2025 of achieving a margin of 33%. We remain very confident that there is no deviation, there is no dip. But when you come out of a once-in-a-life black swan event like a COVID-19, then a quarter one of this year versus quarter one of last year, we should not look at just the percentage in isolation. And that also very few basis points. The absolute amounts were more than what we expected on the top line, on the EBITDA, and including on the profit after tax. So we remain very confident that we have to support our new businesses like Cumin, like Ama, like our reimagined Ginger, and we need to keep making investments and without losing sight on margins. So margins will stay very healthy, will be in line with what we have guided to the market. And we are very focused on giving the required tailwind that the new businesses need, and at the same time, keep in line with the profitability and with the guidance that we have provided during our Capital Market Day and to all the investor community.
Puneet, I just want to clarify, for this India-Pakistan game, those rates that we're getting, I'm reading a couple of reports you'll have to watch the lobbies. I think a lot of people will be spending a lot of time out there going by the room rates. 85,000 rupees per room? Is that the average number that we're hearing? So tell us more.
I think we should not look at a one-off event. We were also all looking at G20, but people tend to forget that the hotels were shut for normal public to go into the restaurants for security reasons. And a day before the arrival and a day after the arrival, the security levels were very tight. So your occupancy drops. But we were able to charge 3 to 4 times higher than we would normally charge. So there is that kind of balance which comes in automatic, but all these events are a very, very big help. This is not just the positioning for that 1 or 2 odd days that the game is happening. It's all those pictures that go through the entire world, which helps in the positioning of the tourism sector. It helps in the positioning of the country, and all those people coming from outside into India, if they extend their stay visiting some of our wonderful spiritual destinations or yoga destinations or other, historical sites, that is what creates the demand that is needed with very contained supply, but that drives the room rates as well as the performance of the sector.
Puneet, just one last question from my side. The business environment overall is looking pretty solid. You launched the Chambers, I think, a couple of years back, I think in FY21. What's the traction there? I mean, how many members are you adding? What's the total? What's the target? And what's the potential here, according to you?
Prashant, it's a very interesting question. Chambers was launched almost more than 40 years ago, but what we have done is we have taken Chambers to a very different level and made it a global platform. So we opened the Chambers in Dubai, we opened the Chambers in London. Recently, we announced a hotel in Frankfurt, which will also have a Chambers. We are opening the renovated Chambers in Taj Lands End in 7 days' time. And we are launching a brand new Chambers in West End, in Bangalore, in another couple of weeks. So I think the entire Chambers as a private membership club proposition across the globe, our ambition or aspiration is to get to 15, which means adding 3 more, maybe one in New York. This is very, very good. This is a very good trend in private membership club. Of course, it is by invitation. It's not that easy to get the Chambers membership for anyone. We have a very very strong selection process for Chambers membership. And yes, at the current level, we have more than 3,000 members. And we expect this to keep growing as we keep adding Chambers in new destinations.
Okay, all right, Puneet, thanks a lot for joining in and giving us a check on how occupancies are shaping up, how room rates are shaping up, and a reality check, actually. If people are paying 85,000 rupees per night for the India-Pakistan match on the 14th, well, some die-hard cricket fans over there. So let's see how that one goes. But thanks a lot, Puneet, for joining in.
Thank you. Thank you for having me.
All right, that's Indian Hotels telling us about what's happening on the ground. But the market is not bad. Like we were saying, the dips are being used as buying opportunities. So the Nifty has recovered from the lows, still down about 100-odd points. But look at that. There is a slight bit of a recovery that we've seen in the last 10, 15 odd minutes. Let's slip into a quick break. The big trigger to watch out for this week is the IT sector that will be reporting Q2 earnings. In our special segment, Quarter Se Quarter Tak, we will talk about that. Also, Kawaljeet Saluja of Kotak Institutional Equities will join in to talk about the IT sector in great detail. Stay tuned. Well, as we were telling you, this is our special segment, Quarter Se Quarter Tak, and the earnings season officially kickstarts this week with IT earnings. TCS is the first one that will come through with their numbers, posting the results on the 11th of October. And then we have Infosys and HCL Tech. Reema is here to tell us what to expect from the large tech names. Reema, over to you.
Thanks so much for that. So the focus is going to be less on the Q2 numbers, but more on signs. Commentary, if the worst of the demand deterioration is behind us, if demand is picking up, there are green shoots, can growth start recovering in H2 of this year, or is it going to be in FY25? Now, IT stocks have seen a pretty smart run-up in Q2. In Q2, the Nifty IT index is up 7.5%. This is in the July to September period, outperforming the Nifty, which has gone up by 1.5%. So this big outperformance has been driven by 2 key factors. 1, strong deal wins, and 2, expectations of a growth recovery in FY25. Now, if you have to summarize Q2 is pretty much going to be a continuation of weakness what we had in the prior 2 quarters. No further deterioration, but no big improvement in outlook. But the highlight is going to be the strong deal wins. So getting to the numbers then, Infosys growth is seen at close to about 1%, which is similar to last quarter. TCS is seen up close to about 0.7%. For Wipro, revenue growth is likely to decline for the 3rd consecutive quarter, but it will still be within the company's guidance. Tech Mahindra is the other IT company which is likely to suffer a quarter-on-quarter drop in their top line. But the highlight of this quarter has been the deal wins. Deal wins have been extremely robust in Q2, particularly large deal wins. So if you remember, Infosys signed a very large deal with Liberty Global. TCS had signed one with JLR. HCL Tech had one with Verizon. According to Kotak, Infosys is likely to report a TCV, total contract value, of $5 to $5.5 billion in the current quarter, which is much higher than their general average of about $2.4 billion. TCS, according to Kotak, could report deal wins worth $12 billion, up 48% year on year. But the question is, when it comes to these very large deals, are they going to be margin dilutive? Now, for Q2, margins are largely likely to be stable. As you can see, there will be a bit of an impact on account of wage hikes here and there. But some of the key factors to watch this time. one on guidance. Now, Infosys FY24 guidance, both on the top line and on the margins, is likely to be maintained. So 1 to 3.5%, EBIT margin seen between 20 to 22%. For HCL Tech, the expectation is that the top line guidance of 6 to 8% could be maintained, but maybe, just maybe, the company could guide for margins to be at the lower end of their guidance. TCS has said that they will consider a buyback along with their numbers on Wednesday. And for Tech Mahindra, the focus is going to be on the strategy under the new CEO and margin recovery. And finally, on valuations. Now, valuations are largely similar to their 5-year average. They're slightly lower than what they were if you compare it to a 3-year average, because the 3-year average also takes into account the post-COVID boom that we had. Tech Mahindra is the only one of the few IT companies where the valuations are higher than what we had compared to the 3-year average. There you have it, 21% versus 20% on expectations of a turnaround under the CEO. Back to you.
All right, thanks very much for that. Rima, that's a comprehensive kind of snapshot looking at IT companies as we get into the earnings season. Kawaljeet Saluja is Executive Director and Head of Research at Kotak Institutional Equities. Kawaljeet, good to have you with us here. Thank you very much for your time. What's your sense, Kawaljeet? Will IT earnings continue to underwhelm broadly for large caps and mid caps?
The numbers are going to be weak across all companies. The revenue growth would be fairly muted. But as Rima summarized it very well, the focus this quarter is going to be the deal wins, and the numbers are going to be fairly robust. But if you're talking purely about the numbers, nothing much to look forward to in the quarter.
Okay, what about TCS? I'm interested, Kawaljeet, to understand how the stock could move post the buyback, because it's already at a 52-week high, and generally post the buyback is when the stock tends to disappoint a bit. The run-up is largely ahead of the buyback. Is this time going to be different, and how should investors approach it?
Buyback is just an alternative form of dividend distribution. So that's basically a part of the regular cycle. So nothing much really to read into it. TCS has a fairly clear payout policy of 100% of free cash flow, and this buyback just ends up achieving that objective. So there's nothing much to read into the buyback. But if you're looking at probably the fundamental performance, then the numbers are going to be muted. But again, the entire focus will be on deal wins, which will be remarkably strong.
All right. Hi, Kawaljeet. Good to see you in. A long while since we chatted, Kawaljeet. I wanted to ask about mid-cap IT companies. Some of these names, given all the risk, talk of slowdown, but they have just been moving in one direction, and some of them are at a big premium in comparison to the large cap names. Your view on mid-cap IT from here on?
I guess, I struggle with this general clustering of companies, one set of large cap companies, another set of mid cap companies, In large cap companies, you have certain companies that are underperforming, which are the likes of, let's say, Wipro, Tech Mahindra. In mid cap as well, you'll have similar companies underperforming. Now, there are certain leaders in mid caps, there are certain leaders in large caps. What you have to focus on is companies which have the right model, right leadership, and can compound consistently. Companies, which have those attributes will pay at a premium. So let's say Persistent, which has been delivering quite well for some time, should ideally trade at a premium. And LTIMindtree, which has grown at, let's say, 2 to 4 percentage points higher than some of the large companies, does deserve to trade at a premium. And then there are laggards as well within mid caps. So I guess, to not cluster companies just basis, size definition. There are companies which have scalability attributes, and then there are large companies which have challenges. So just take every stock, on its own merit.
There were some large deals that Infosys signed in this quarter gone by, right? So I'm just trying to understand what is the expectation from that. And is there any change in the FY24 guidance that the company has given out? I think the revenue guidance was 1% to 3.5%. Do you expect any tweaking of that?
Not much, really. I think they basically retain the guidance. Maybe, if at all they have to do something, they might just take the lower end of the guidance band up a little bit. But FY24, I don't think the large deals will contribute a whole lot to revenues. I think the big contribution of these large deals will come in FY 2025. And, I just see actually that Liberty Global deal is mentioned at £5 billion. My guess is that it's 1.6 billion pounds, about 1.6 billion euros rather than 5 billion euros. So I guess, but when Infosys reports the mega deal wins or the overall deal wins, that number will be remarkably strong at $5.5 to $6 billion, which is our estimate as compared to the last 8-quarter average of $2.4 billion.
Kawaljeet, hi. This is just to kind of take a slightly macro-ish view here. U.S. interest rates have gone up about 450 basis points, roughly. This is comparable to what we saw in the 2007-8 period, right? I mean, actually 2006 to 2008 kind of period. Back then, of course, there was subprime, etc. Something broke. This time, nothing. It seems to be pretty all clear. But if we were to get into some unexpected trouble, with US still being the biggest market, do you expect that? Because a lot of debate whether whether it can be so perfect, the so-called soft landing, that not too hot, not too cold, or do you think it'll be a little bit messier? Your sense?
No, that has been an overarching worry, actually, in the IT services sector over the last 12 to 18 months. And that's something, which keeps you awake in the middle of the night as to what's going to happen, what will the state of macro? Our base case assumption for FY 2025 is, a soft landing, and which is, forms the basis of our forecast. If there are any changes, to the macro, environment, then we'll have to change our estimates accordingly to reflect the new reality. But I think, the macro for the time being is a concern.
Okay, all right. We won't have to wait too long to find out from the managements, right? This week we'll know more. Kawaljeet, thanks a lot for stopping by. And as Nigel was saying, seeing you after a very long time. So hopefully we'll get to see you more often on the channel. Thanks a lot for being with us. All right, well, that's the word on the IT space. That's a big trigger to watch out for this week. But the other, positive trigger we've got is from the real estate space. Prestige Estates reported a very good set of Q2 business updates. The pre-sales have more than doubled. Sales volumes are up 50% as well. The average Q2 realizations have gained by 29%. Do note, the company has launched 5 projects in Q2 spanning 13.1 million square feet in both Hyderabad and Bengaluru alone. To discuss demand trends, we have Irfan Razak, the Chairman and Managing Director at Prestige Group, who joins in. Mr. Razak, good morning and thanks a lot for being with us. There is sort of a hyperactivity in the real estate space, especially in these markets like Hyderabad and Bangalore, if you map the last 1 year, right? Just trying to understand, what does this mean in terms of numbers? I mean, you have almost done in the first half of this year what you did in all of FY23. So just trying to understand, what could the run rate be in the second half of the year in terms of pre-sales?
Morning, Sonia. Yes, I think the teams have really worked hard. Bangalore has contributed the maximum during the quarter that's gone by, because we had some 2-3 very good launches, and that added up to the numbers. And I believe that there is opportunity in all the cities that we are working in. It's only a question of what type of product you bring into the market, what is your location, and how you've priced your product. And that gives us the courage to do more. We are pretty bullish on all the cities, including Mumbai, Hyderabad, Chennai, and of course, Bangalore. Bangalore has given us the maximum this quarter. And I think the current quarter will be the quarter of the outstation, including Mumbai, Hyderabad, and Chennai. And I think these 3 cities will give us numbers for the current quarter.
So just to pin you down to some numbers, right? So you did about 7,000 crores of pre-sales in quarter 2. Is that a run rate that you can do in Q3 and Q4? Can you do better than that? And if yes, this target of 20 to 25% growth in pre-sales that you gave out for FY24, would you want to change that in any way?
I think to match the 7,000 again in the current quarter will be pretty tough. It's all a function of the launches that we do. We did 13.1 million, like you rightly said. But I believe that the next 2 quarters also will be good. We have a slew of launches, a lot of good products coming in from different cities. So we should cross whatever guidance we gave in the beginning of the year. And I believe that we should touch the 20K mark. And that will be another high that we would have achieved during our history.
Just to clarify that number, sir, earlier you were telling us 20-25% growth in pre-sales. But now you're saying just going by the run rate, you should easily get past that. So for FY24, what kind of pre-sales growth are you looking at? What's the revised number?
I think we are looking at around 20K because since we've already done 11,000 plus. So the next quarters, there's a lot of launches that are coming up. And if I get my approvals in place and the RERA number, we should be able to do the 20K, and I'll be disappointed. Yeah.
Okay. Mr. Razak, hi, good morning. Could you tell us, what was... Hi, sir. What was Mumbai's contribution to this particular quarter which has gone by? How is the quarter we are in? How is that panning out? And what's the traction here?
Mumbai gave us 500 crores, 500 plus crores this quarter. And I believe that in the current quarter, Mumbai will give us more because we've got a very big launch called the Ocean Towers, Prestige Ocean Towers in Marine Lines. And we do have the sustenance sales in the projects that we are already under construction. All this will add up, and I think Mumbai should give us some great numbers. Hyderabad, we are launching the Prestige City Hyderabad in this quarter. Hyderabad should give us some good numbers now. And with Hyderabad, Chennai, and Prestige Pallava Gardens in Chennai, I believe these three cities should take us through the target that we have in mind for this quarter as well as the following quarter. And we should cross that 20K mark very easily. The teams, of course, are working hard, and that's what matters.
Your projected annuity is expected to double to FY24, right? What will lead to this? And if you can tell us what is the current commercial portfolio size, and over the next, say, 5 years, what will the portfolio size grow to in the commercial space?
So, see, currently we have annuity coming from three sources. One is the office, which is pretty straightforward. The other is the retail malls. In the quarter gone by, we opened the Forum Kochi in Kochi, and that has been a hit. We've had great footfalls there, and I believe there will be a lot of revenue that will come from that retail asset. So we'll have three retail assets that are going to be trading, and very soon, like you said, by 525, we'll have a couple more. Similarly, in the office space, we are completing the Prestige Alpha Tech in Pune, and that's almost 1 million square feet. And even that has been fully leased out, so that also will add up to our annuity portfolio. So we are working towards that. And whatever we are constructing, we are making sure that it gets either pre-leased or gets leased as soon as it gets ready. And I believe that there is a lot of traction there. And vacancy levels are pretty low. It's pretty under control. There's nothing cause for us to be concerned about.
Okay, demand is strong. Volumes are good. New launches as well coming about. What about pricing, Mr. Razak? Final question before we let you go. Is demand strong enough to push through further price increases? And give us a rough sense. I believe that pricing in this year is up by more than 20%. Could you give us the number? How much have prices moved up by now? And do you see further scope from here on?
See, if you look at the average realization in the last 2 quarters, it's around the 10,000. It's breached the 10,000 mark. And I believe prices will stabilize here. I don't see prices going up further. Of course, in certain micro markets, depends on whichever product that you are launching, the pricing will be different. But I personally wouldn't want prices to go up too high, too fast. Again, that becomes counterproductive. If I'm able to control my costs, I'm able to control the land input as well as construction input, and able to offer to the customer at a decent number and keep the momentum, that will be our endeavor. Prices have definitely grown much higher than what they were in the last year. And I would probably want them to stabilize here and not go up further. because, as I said, the traction will be lost and it will be counterproductive. And we are working at some mid-income housing projects also, where we'll probably have a much lower number.
All right. Well, a lot of your clientele would be breathing a sigh of relief on that. You expect prices to consolidate at these levels, but otherwise, broadly, the commentary is very, very positive. Thanks so much for joining in, Mr. Razak, and wishing you all the best for the second half of the year.
Thank you.
By the way, the markets have seen a big recovery from the day's low. As we suggested earlier, the markets need to hold on to the 19,470. It's bounced close to around 80 points from those lows. So sustaining these levels is very, very important. For the time being, slip into a short break. You come back. Mitesh Thakur will be joining us. Tell us his technical trades.
Okay, there is a decent bounce which has come through from the day's low. The markets, I think, recovered, although it's still work in progress, but it's a decent bounce, no doubt about it. The low was 19,480, and we are about 80, 90 points off that level. We're at about 19,569. Mitesh is with us with fresh trades and what he would do now. Mitesh, hi. Good morning.
Morning, Prashant. So I think on the index, we haven't taken a trade yet, despite the fact that there was some panic in the morning and then a good recovery. I think, we have a gap down since yesterday, or rather Friday, and the Friday's low was 19,590. So I think once we start capturing that, maybe you'll look at the trade on the long side. But for the timing, avoid. And on the stock side, oil India is something, which is breaking and making into a fresh high. So that's a buy with a stop at 297. look for a target of around 320 here. And some selling observed in Adani Group stocks. So I have a sell on Adani Ports. That's a stock which is again broken down with a gap today. So recommending a sell here. Keep the stop at about levels of 822 and a target of 770 is what I'm looking at.
All right. Thanks a lot for that. Mitesh, have a good day. Let's shift focus to the commodity markets because that's where a lot of the action is. There's been a big move on crude. There's so much happening with the Israel-Palestine conflict. Manisha is here to give us the latest on all of that. Manisha, what are you tracking today?
Thank you for that, Sonia. Well, I'm keeping an eye on the crude oil prices because we've seen big moves come into this one. Let me remind you that last week we saw crude oil prices decline by 8%. And the first tick or the first trade in the Asian markets today was 5% on the higher side. 4.5% on the higher side has still been holding, but from those kind of levels as well, we've seen some profit taking coming on the higher sides here. Well, the markets are looking at the Palestine and the Israel concerns. There is concerns about escalation of there as well. What the street is looking at is that there are no supply concerns as of now. This is all sentiment that the markets are seeing. So what the street is calling this is a knee-jerk reaction. There is no supply impact really because when you look at Israel, they don't produce oil. They do refine oil, and both the two oil refineries that they have, the total capacity of that is 300,000 barrels per day. We haven't heard anything on that yet. Palestine, on the other side, does not do anything in case of crude oil production or refining for that matter. So on ground, there is no impact on supplies as yet. The markets do believe that as we go ahead, if this concern or the conflict widens, then we could be looking at Iran stepping in. There already are reports on how Iran could be planned in these attacks, could be involved in planning of these attacks. If Iran comes in, if it gets widened, then you could be looking at supply concerns coming in. At this point in time, there is nothing like that. But the markets also do believe that this is not going to get over in a day or two. That is what the report from Citi, Exim Australia, even Vanda Insights told us on CNBC-TV18. If you look at the fundamentals, well, we haven't seen much change on that. The immediate gain in crude prices also came in after the weekend when we saw all of these countries reaffirm their statements that they will taper with the oil output depending on what kind of demand do we look forward on. And that exactly is the thing. When you look at the demand from China continues to be on the weaker side, there's no fundamental change on ground really. And the US gasoline stocks have gained the highest since 2022 in US. Also, when you look at the gasoline demand in US, that is the lowest in at least 4 decades right now for this time of the year. And that would continue to weigh onto the market. Russia also has said that it will allow gasoline exports via ports. So that is almost 50% of that fuel also back into the markets. So when you look at the on-ground fundamental demand and supply, there's no change in that. It is a sentiment move that we have seen come in for the crude oil prices. And this tells you on how the crude has been in this year until now. We started with 82, we went to 70 in the month of June. September saw high at 96, which also is an 11-month highs, by the way. And then we saw a sharp decline. 1st of October opened with 85, and we have seen a turnaround on that yet again. So 88 is trading at this point in time on the screens. So continues to be very, very volatile. Markets do believe that until the end of this year, now you have a wide range, anywhere between 82 on the lower side to 102 on the higher side.
Manisha, thank you very much for that. That's commodities and oil in focus. Well, let's just shift the focus back to stocks once again. MCX, we highlighted that right in the morning. It's up 4%. Sudarshan is here with a spotlight on that stock. Sudarshan, morning.
Good morning. Yes, CNBC-TV18 News Break is confirmed and MCX is buzzing in trade. The regulator SEBI's technical advisory panel has given the green signal for MCX to shift to the new platform. And as for the company, the panel has taken this decision after going through the submission made by MCX in regard to the complaint by Chennai Financial Markets and Accountability, which is known as CFMA, before Madras High Court. CFMA had raised technical issue in the platforms, and that case is now likely to be heard on November 29. As per the disclosure by MCX, it seems SEBI's panel was satisfied by its response, and it has asked the company to submit go-live date of new platform to SEBI. Following this update, SEBI has withdrawn its September 29 order of keeping the shift to new platform in abeyance. Now we need to wait for MCX to announce the go-live date, and just for the reference, I would say MCX has an agreement with 63 months till December 2023, and what I understand from my sources, it would keep that platform till the expiry and use it as a backup till then. Also, as per analysts, there will be major cost saving post the shift to new platform. Currently, company pays rupees 125 crore per quarter, which is almost 100% of sales of a quarter. It's expected to fall to 10 to 12% of the sales after the shifting to the new platform.
Thanks a lot for that. Well, let's move on. Solar Industries and GOCL Corp are two stocks in focus. Solar Industries actually bagged its biggest ever order, so that is definitely takes center stage. Vivek is here to give us the latest on all of that. Vivek.
Well, absolutely right. It's a large, sizable order. Solar Industries received an order from Coal India, and the value of this particular order is over 1,850 crore. Now, to put this in perspective, the total order book of the company at the end of Q1 FY24 was just around 2,700 crore. And this includes the defense order book of close to 1,050 crore. So, large, sizable order win coming in. And this particular order will be delivered over the next 2 years. Now, what the management told last time is that the annual guidance is 700 crore revenue from defense itself, and currently 155 crore per quarter is what is anticipated, which will go ahead and increase to 175 crores. Now, the other company that we're tracking, GOCL, the company wholly owned subsidiary IDL Explosive, received orders worth over 760 crore from Coal India. Now, this is again for supply of bulk explosive. The company has a order book of over 550 crore.
All right, thanks very much for that, Vivek. So those are two names to focus on with Newsflow. We'll take a quick commercial break here, but stay with us. We are coming back with the management of Som Distilleries. So we'll ask them the impact of the GST cut on molasses, whether they are impacted and what way was the industry impact. And to discuss some of the other things which came through from the GST Council meeting on Saturday, Rohan Shah, Tax Counsel, will also be with us. Stay tuned.
Well, the GST Council cedes the right to tax extra neutral alcohol to the states. GST on molasses gets slashed to 5% from 28%, while the council also decides to not levy any GST on millet flour containing at least 70% millet composition. However, a 5% GST will be levied on branded millet products. Well, the government has, called 2023 the year of the millet, so hence they've made this decision. J.K. Arora, the chairman at Som Distilleries, and Rohan Shah of the Tax Council joins us now to talk about that. Mr. Arora, good morning, and Rohan, good morning to you too. Let me start with Mr. J.K. Arora. The question to you, sir, is that, you operate on about 40 to 43% gross margin levels. Can you tell us how much of your material cost is ENA from molasses, and the fact that this GST rate has been slashed, right, to 5%, what kind of impact would it have on your own business?
So actually, on the alcohol which we use, there has been a GST department has been disputing and putting the tax on the alcohol which we use, and there has been few High Court also have been given a ruling that the GST on the alcohol is a valid. But one thing is very, very clear from the Constitution of India, that manufacturing of liquor, storage, transport, licensing is all within the state domain. So actually, I am clear from the day one that GST cannot impose the tax on the alcohol because it's a state subject. Only thing is they can put the taxes on the industrial use, which has been finally now, after lot of persuasion and lot of litigations, GST Council has clarified that tax on the liquor, on the alcohol used, GST is not applicable. I think this is a good clarification, and lot of litigation will end since they are going to issue the clarification also. So I think this will end lot of litigation.
This had been, Mr. Arora, hi, good morning. This had been being issued by state governments, sir? This was being levied by state governments?
No, GST is the central
yes,
government.
I know.
It's the federal government. Yeah.
But there were some appeals, etc. I think in Uttar Pradesh, for example, there was some...
Andhra.
Correct. So there was some dispute going on, right, at the courts?
Yes. Lot of dispute. The crores of rupees of demands have been issued by the GST department.
So all of that gets resolved. All of that gets resolved now, sir.
Yes. Of course, because it is the clarification is a very much. Actually, there was no dispute, but in the anxiety of having the more and more taxes by the GST department, they were actually imposing, I would say, a bit unfairly. But because Constitution is very, very clear, and the Constitution is above all acts, law, High Courts, it's above all, it is this thing. So I don't think this thing, but finally, anything, it is cleared by the GST themselves. So it is nice, I would say, it's a good development for the industry.
Okay, we have Rohan Shah, who is from the Tax Council, who's also been waiting by patiently. There is a GST that has been imposed on corporate guarantees, that 18% level. I just wanted to understand what is your view on that, and how do you think, what would be the way forward now?
Yeah, so the GST on corporate guarantees, I think, has been a contentious issue for the last 6 or 7 years. And there have been a series of demands in relation to those. And the stance of most industries has been that it's nothing but a financial facilitation, typically given by a parent or a holding company. And from that perspective, there's no rendition of service, because the parent or the holding company is really doing this in a way to sort of address cash flows or capital contributions into a subsidiary, which, if they can get that through a corporate guarantee or a bank guarantee, effectively assists them and aids them also. So from that perspective, this has been contentious. The fact that they now clarify that it will be liable, I think, raises the other issue that therefore is this liability only prospective? Because if it is prospective, then all these past demands ought to go. If they say it is clarificatory, then of course these past demands in a way are affirmed. But to my mind, the way in which the change comes in, and at 18%, it's quite clear that this should now be prospective, and whatever is the litigation in which is already embedded in the system should, in a manner, now go away, because the tax, if at all, can only come from the new date that is notified.
But will we get a separate kind of clarification to say whether this is clarificatory in nature, as you said, or this is the earlier demands will stand? I mean, what's the?
Look, given the amount of litigation that there is, I think there will still be some amount of push and pull. But the way in which this is drafted, I would think it is prospective. And yes, they will probably issue a clarification to say that it is prospective and all of the past demands therefore should abate.
On the other issue, which is online money gaming, casinos, etc., that issue is also settled now, Mr. Shah?
Not really. I think those issues, the amounts are what they are, now running into an excess of 1.2 lakhs of demands. And that continues. I think we are seeing even more recent statements from the Revenue Secretary to say that they believe even the intended amendments are only clarificatory.
Correct.
So I think we are really looking at a full-blown legal battle.
Okay. So this will go to the courts, and the courts will have to take a view. Because
there are already writ petitions filed in a few courts.
Correct. From the tax department's perspective, the issue is settled. I mean, they're saying, well, this is clarificatory, so this was always there. So this is just a reiteration.
Well, it's a nice way of putting it. It's settled subject to court. So what that means, ultimately, the court will have the last word.
And so, first, we have listed companies as well, which are where large sort of notices have been sent out to. So, for investors, what does this mean? I mean, long, protracted kind of legal battle at the courts? I mean, a few years at least before we get to any kind of... finally, the issue is decided one way or the other?
Yeah, I think, yes, this is going to only get settled by the courts. There is already a pending matter in Gamescraft, which is in the Supreme Court. And there is a positive order there from the Bangalore High Court, which was in favor of the SSC. That has been stayed by the Supreme Court. I think Supreme Court will hear this on a prioritized basis. So while it will get settled by litigation, I don't think the issue will pend for very long, because I think the Supreme Court will find a suitable date in its calendar to, take up this issue and deal with it.
All right, we leave it at that. Thanks a lot for joining in and talking about the GST Council meeting and the implications that it would have. By the way, the market has recovered quite a bit from the lows. We started off with a 150-point cut. Now the cut has restricted itself to about 70-odd points. So we've pulled back from the lows of trade, and lots of individual stocks are seeing buying action. So we'll take it forward on our next show, Chart Busters, that is coming up next. Do stay tuned in.